Sometimes I wonder if anybody. Sometimes I turn off the thing and everyone's like, "Oh, what just happened? You went off the air." All right. And again, just to let you guys know, if you have any questions for Vander, you just fire them in fast. Send them to onair@daytradingradio.com, or send them in on your tweets to Day Trading Radio. One day I will get that right, and it'll probably be the day it goes out of favor. Day Trading Radio @Day Radio. And again, let me just get my get everything set up here. Looking forward to this. Draw the lines, please. All right, let me get my lines in there. Let's take a look here at what we have shown. Line it up here. We had a gap up and a little consolidation here, so I'm going to throw that in here right about here. Kind of breaking through that. There's not much here to look at as in trend lines. This would be something to see if we regain this level here. I'm not even going to put it in here, but let's just pretend that this area is where this trend line comes in. So it does look good here. I am getting a high probability bounce area here too, so just to let you know that. And that's really not many of those setting up today. So the pullback here, let's take a fast look at the 5-minute chart too. This is, remember, we always want to also pay attention to that 5-minute stochastic, because on a bullish day like this will give you the only real pullback area is when you get that first pullback into the oversold level. We're not quite there yet, so this is really the best way of measuring that pullback. You pay attention to the 20 and the stochastics. You would love to have that lining up. Pull back here, holding above the 20 is a very bullish thing, and you know that's going to happen at one point today. It's just a matter of, again, having the patience to hang out in the market here. So we don't know if it's going to pull back to 1235 or, you know, all in this area could be in play, but really waiting for those stochastics to set up. All right. All right, so we're going to give Vander a call. You give me his number here. First question I ask him is, what kind of name is Vander? I think that's his first name. I bet is it Vander like a Dutch name? Or is it an Indian name? Like Van. All right, here we go. Turn down the other things here. It is Dutch, right? I knew it. I'm so good at that stuff. I could be a circus, someone at a circus, and tell me your name, I'll tell you where you're from. Maybe this is a Vander Holyfield.
Hello.
Hey, Vander.
Hey, how are you, sir?
How you doing?
Not bad, not bad. I'm ready for this.
Good. I'm excited about it. You know, it's always good to talk to someone, especially a member. You've been very kind with your emails and stuff, and you kind of gave me some of your background And you know, over the history of your membership, you've again made yourself known, and that's great. So I got to thank you for stepping up. It's hard sometimes to get on the radio and talk about things that are so not talked about. But I take this as one of the greatest opportunities for the members out here to hear from someone from your experience. All right. So you're Vander. Vander's Dutch. That was my first question. Is it? It's Dutch, right?
Yeah, it's Dutch, but I'm far from Dutch. I'm married to a German, so that puts me halfway there. And just a handle that I've used, over the years. And I figured why not? When I signed up for this service, I just put it on there and it kind of stuck. So, we'll just leave it at that. But my background is really, kind of varied. I have some Spanish descent and some French in there. My grandmother was French.
Oh, all right.
So anyway, I prepared. I started thinking last night about all the things that I could talk about that most of the guys in the room probably don't get a lot of exposure to. I'm not going to talk about, trading levels and fibs and retracements, because that's why I'm here. I'm trying to learn that from you guys. But what I can share is what happens behind the scenes at, a lot of the banks and Wall Street type firms on certain days of the year, and how it affects specific stocks, indices, especially those linked indices. That's huge.
This is great.
So I got a little bit of an outline here. I just wanted to let everybody know what I'm going to talk about, and then I'm going to give specific examples of some stocks that are going to be pushed around pretty good today towards the end of the day.
Okay, let me jump in here for a second and say, again, like what we're going to talk about is, well, again, you're going to probably explain to some of the things you're going to talk about, but you just mentioned, say, you're going to talk about some of the stocks that are going to be pushed around here today. And you're going to give us a why, we want to start off with that. Why are some stocks going to be pushed around today? Now, let's back it up a little. Let's back it up. Let me let you do your thing. You seem to come prepared. I want to hear more about your background. I'm sure everyone wants to hear that. And then go ahead, take it away. It seems like you're going to run my show today, Vander.
Well, I'm going to try to make it as brief as possible without going into a personal rant into my opinions of the market.
Okay, good.
Given up as to what's happened today, and I talked to some people earlier sitting at desks, which is how I got some of this information, and getting their 2 cents of what they're thinking. What I can tell you is November 30th, the fact that it's month end heading into December it's a very important day of the year, because it marks the beginning of the last chance for firms to, number one, prop up their stock, for banks to pay commissions. There's a lot of window dressing. You got the December effect. There's the last chance for portfolio managers to align their portfolios, and that always tied to compensation. So I'm going to talk about, the Wall Street bonuses, something that, you indicated some people wanted to know about. I'm going to mention high-frequency trading. I'm going to mention rebalancings, why they're important, why they move the markets, why everybody should care about them, beginning with a daily market on close imbalances, which I tend to post when I get the info.
Okay.
And month ends, and why there's a bias for, historically, markets tend to move higher into month end, going back. The data supports it, and I'm going to post some specific links where people can go and see articles and data that, they want to dwell further into it. It's there. I'm going to talk about briefly, the annual Russell reconstitution, ETF rebalances, S&P rebalances, add deletes, quarterly revals. Those are the kind of things Wall Street firms look at specifically. And then there's an MSCI reval, which is the Morgan Stanley indices, which are widely followed on a global basis. And that is a huge event, and that's happening today at the close. I was able to get my hands on some information. I'm just going to post, the biggest 10 and,
okay. That sounds
good. Buys and sells. I'll do that at the end, because if I do it now, I'm going to lose everyone.
All right. Well, it sounds like there's so much information here. I can't wait to just dig into. I'm ready to just jump in and say, hey, tell me this, tell me that. So.
All right. So, just by way of background, just to let you guys know, because a lot of people tend to ask, how somebody like me ends up working, on Wall Street and why I left and all that. And I'll try to make it brief. I I graduated school in December '90 in the middle of the Gulf War, and there were no jobs. So I went to work for a small nonprofit called Bond Investors in South Florida, and I just wanted to be in the business, so I worked for next to nothing. And I was doing fixed income analysis, publishing a lot of newsletters. I was writing a lot of articles. I got published in certain newspapers and periodicals like Crane's Interest Journal. I got published in Nikkei. Bloomberg used to pay us quite a bit of money to fill in the gaps of information on defaulted bonds. And basically, this came out of all the companies coming out of the 80s that were had a lot of high-yield paper, you know, the Milkins, the Icons, all that stuff. Well, into the 90s, interest rates dropped. They couldn't make their interest payments. Moms and pops got stuck holding the bonds. They got screwed. They had nowhere to turn, so this company came up with a service. Eventually, it's evolved, and now he's got a column in Forbes magazine under Richard Lehman. Some people might have seen it. But bottom line is, you know, it was a decent company. It was a good place to start. And I learned a lot of analysis, and they have some very good newsletters that cover preferred stocks and convertibles, that sort of stuff. If anybody cares, you know, I'm just going to put a link in here. I'm going to put a bunch of links as I talk.
Oh, great.
And look, I think you can download a free sample of their newsletters there. I just put that link in there. But anyway, needless to say, I got paid squat, but I learned a great deal. I then, after 3 years, went to a small minority-owned investment bank to do more fixed income research and help them in their municipal underwriting. You know, basically there were underwriters for a lot of bond issues, and I'll briefly share how they end up being part of that, being such a small company. Eventually, the bankers left and went to bigger firms. I got stuck doing the underwriting, and so I learned quite a bit. It was very political. You had to sort of like grease palms of public officials in order to get deals.
Wow.
I didn't really like it. So I eventually wanted to get on the equity side of things. Now, the firm at the time was trying to get into equity trading, so I jumped at the opportunity. I had a background in IT, so I started programming Perl scripts for conversion programs and hooking up all the equipment. And we had UDS modems. I mean, it was pretty antiquated, but I learned quite a bit, and I learned how to deal with institutions who have to give a percentage of commissions to minority brokers. That happens even today. So if you ever see, you know, a deal coming on like Groupon, let's say, I haven't seen the prospectus, but if you look at the prospectus, it's going to show you all the underwriters that are on there, the Merrills and the Goldmans, and you're going to see some little no names. They're all going to have a woman-owned firm, a Hispanic-owned firm, and a black-owned firm. And that's just how it works. So it's needless to say that's just how it goes. I'm not happy about it, but I learned quite a bit as to how to get on the map for some of these smaller firms. So some inside info on how these things work. The owner of this firm, we used to contribute to Rainbow Push. Rainbow Push Coalition is formed by Al Sharpton and Jesse Jackson. And in turn, they forced banks to include minority firms on their underwritings. Now, this was in the mid-'90s, so you had a ton of dot-com deals coming up, you know, the Yahoos of the world. And at the same time, there were a lot of corporate bonds coming out as well. And, you know, they had to include us. They didn't want us involved in any of the work. So at the end of the day, we got allocations of shares and bonds and checks for doing nothing. I didn't see a dime of that. At the end of the day, that was all distributed amongst the owners and their trust funds for their kids and their family members, etc. So I realized that I was not going to make any money there, and I wanted to parlay all that experience onto Wall Street. So after a few years, I wanted to take a leap, but it took me about 3.5, 4 years to get finally into New York, since I neither went to the right school nor knew anybody on the inside who could get me a job. You know, I basically had to come in through the back door, work twice as hard for half the money, but I kept knocking, and eventually I got a call from Prudential asking me to be there next week, and I jumped on it, and that was at the beginning of 2000, and I was extremely happy to just simply be there now.
Wow.
My perception of what Wall Street firms were a bit different. You know, I thought, you know, you have people who are very highly educated, very wealthy, have the world at their feet, travel a lot, you know, might be a little bit more, I don't know, what do you call it, sophisticated and worldly than in their worldviews than I thought. At the end of the day, you know, I was very wrong. It's a very close-knit circle of people, and, you know, they hire each other and take care of each other, and that's just how it goes.
Yeah.
And but I was happy to be part of it. Now, the first week I was there, this was March of 2000, the dot-com bubble blew up, and that was a disaster.
Perfect.
But all people cared about was how they were going to get paid. And meanwhile, I was just happy to be there watching, you know. So I learned a lot about the culture of Wall Street in a very short period of time. A year after that, 9/11 happened, and business went to zero. So, you know, I was off to a great start. But I learned the ropes about, you know, program trading, index arb, portfolio management, corporate buybacks, how institutional clients work, what they need, index changes, rebalancings. And eventually, as people started leaving for better jobs, whatever, I started picking up all the pieces. All the things people didn't want to do, I was doing, because I figured it's just a feather in my cap. It's going to help me down the road. And even though I wasn't getting paid well for it, I knew eventually I would.
Yeah.
And after a few years, I made a leap to Fidelity. Now, I jumped in there while their desk was going into shambles. There was a lot of lack of leadership on the within the broker-dealer at Fidelity. I'm not talking about the mutual fund company. I mean, it's part of the mutual fund company, but I'm not dealing with a mutual fund. They have their own little broker-dealer that deals with all the different parts of Fidelity. You know, Fidelity is humongous, and one of the things they wanted to do for the longest time was shut Wall Street firms out from manipulating their order flow, and the way to do that was to create their own BD. Well, when I got there, I was able to pick up some pieces, put together a desk, and you know, I figured out really quick client relationships were very important, and I was able to parlay a lot of Prudential clients over there. I grew that desk. After 5 years, I left, and I didn't want to leave. I loved it there. But in 2009, when Lehman and Bear Stearns collapsed, some of those people were hired, and some of those guys were, you know, buddies with the guys up in Boston, you know, and they were put in as, let's just say, I was expected to hand the reins of everything over to them at some point, and I just didn't want to do that, so I left.
Yeah.
And I ended up going to a smaller place for the last 2 years, which, you know, I'm not going to mention simply because, you know, there's still some pending things there. I went in for certain reasons. Went through a few mergers. And after those mergers, it looked like, you know, the reasons I went there were no longer going to hold to be true.
Yeah.
And, you know, I just wasn't motivated to go into work, so I left. And, you know, we settled on an agreement, and, you know, that brings me basically to today.
Yeah.
But, and that goes to, and one of the things that I'll mention is when I was at Prudential, just so you guys know, after 9/11, you had decimalization came. Now, that changed everything on Wall Street, really. They had about 150 over-the-counter market makers at that firm, and that was one of the smaller ones. There were places like Truster, Singer, Mayer, Schweitzer.
Let me break in a second, Vander, and just ask you something. I want to ask you some questions today, every so often, that maybe some of the newer listeners that out there might not know some of the terminology. So I'm just going to ask. I'm just going to jump in there. When you say market, they have 150 market makers. Explain what that is.
Well, market makers come in a variety of flavors. At the time, you had guys who sit on the block desk. Block desk being, let's say, I don't know, Putnam or Fidelity or Wellington wants to buy 1 million shares of XYZ. Well, you know, they're not going to go into the open marketplace and trade it themselves, so they go to a liquidity provider like a broker-dealer, and they have a guy who sits there, and he might be a specialist in energy stocks. Mm-hmm. And that guy knows who owns what stocks, who's looking to sell what stocks, and he's basically just matching buyers and sellers.
Okay.
It's very similar to what the specialists on the floor of the exchange do.
Yeah.
Now, on the floor of the exchange, you have a team of guys who talk to the market makers, you know, market maker takes the order from the client, the institution. He calls down to the floor. You get your guy on the floor who works for your firm, and you tell him, this is what I'm trying to do. He goes and talks to the specialist. They're all buddies down there. And he tries to figure out what's really going on, how best to execute it. And also, you know, the specialist wants to make money on it, too. So, you know, how do you keep everybody happy? And that was the way that game was played.
Let me jump in there for a second, because I don't want to miss this question. When you say that there's a process where someone's they have a bunch of orders, they want to buy something or sell something, they contact the market maker, and then market maker contacts the floor, and they're figuring out how to route this or what's the best way of doing that. Somewhere along the way, it seems like there is an opportunity to profit from that information. Meaning, if someone,
yeah, absolutely.
Now, if that's going on today, you know, there's always someone who has the early scoop of you know, tremendous amount of shares being offered or being, you know, looked for on the market, right? I mean, that has to be a dead giveaway. I mean, how do you?
Well, it sort of is, but it's no different than the guy that we listened to in the pit of the S&P, right?
It is. Well, yeah, true.
There and he's looking. He's saying, like yesterday, towards the end, he's saying, I see Goldman. He's standing here. He has something big, but I don't know what it is.
Exactly.
But he knows Goldman's going to do something, but because he's there, whenever that guy from Goldman opens his mouth, he's going to know if he's a buyer or seller. You know, a lot of times when I was trading corporate buybacks for a while, and I had to be in line with a specialist, and I would use a variety of different people to go down there and talk to the specialist. Why? Because other people standing in that crowd, when there was a crowd, obviously there isn't one anymore, but they're waiting for that same guy to come back. And when they come back, they know that, oh, listen, the buyback guy's back. You know, they're going to jump in front of me.
They're going to jump, yeah.
So, exactly. So, but that happens on the floor. I mean, that's not happening necessarily on the institutional level. So, if Putnam, let's say, has an order to buy 1 million shares of something, and let's say a hedge fund finds out and jumps in front of it, someone's going to get fired.
Yeah.
I'm not saying it doesn't happen, but for the most part, I've seen people get fired because they call that hedge fund and say, hey, I'm a huge buyer of XYZ.
Yep.
And the hedge fund will turn around and say, well, I'm not interested right now. And at the end of the day, they come in and say, hey, listen, thanks for the data. Here's my sell, because they already ran it up. Now they want to get out.
Well, why would, so they're just telling the head.
The initial client finds out about it, and he comes questioning. You know, people get fired over that stuff.
Yeah. Well, oh, wow. It just seems like there's definitely a way of profiting off of information, especially when there's multiple, you know, a chain with multiple people that has to go through to execute things. So, I mean, I just wanted to touch base on that when you mentioned that, you know, you're market makers. So, all right, so I'll let you pick it back up. But like I said, I'd love to jump in every so often just to.
Yeah, no, not a problem. So basically, the market makers, you had, you know, listed and over the counter.
Yeah.
OTC was NASDAQ names, a 4-letter ticker. And the market makers there, those were the guys who were sitting there making, you know, matching bids and offers like the specialist did on the floor for New York Stock Exchange stocks. But these guys were doing it in eighths and quarters and halves. They were making tons of money. I mean, it was ridiculous. And all of a sudden, decimalization came. And NASDAQ level 2 came around. And then you had computers doing it. So they didn't need these guys. I saw, you know, that whole industry disappear in 6 months. I mean, thousands of people got laid off. A lot of those guys never made it back because all they knew how to do was make markets for over-the-counter stocks. And you can't really parlay or reinvent yourself into something different. You know, you're a one-trick pony.
Yeah.
But a lot of those guys made a ton of money. So that's kind of like the first, I guess, step one of where high-frequency trading is born, is through the automation of NASDAQ market making. They didn't need people anymore. You have computers matching buyers and sellers.
Yep.
So that's step one. Then, let's see here. Going to high-frequency trading, which is something you wanted me to talk about, I was able to see firsthand how it evolved, especially on the program trading side of things. One of the things that I did for a long time was VWAP orders. You know, everybody knows sort of like the volume-weighted average price of an order, but for a very, very long time, that was the benchmark. So a lot of people gave you, institutions, they would give you an order, and they would say, I want you to VWAP this between this time and this time. And if you perform better than the VWAP, you get more orders, and if you didn't, they go to another broker. So it was crucial to do well. And all I did was trade VWAP. So I would sit there and figure out what the volume curve is, split it into small time periods, and trade within each time period, with whether it was 10 minutes or 15. So from a very early time, I was sort of like trained in my brain where, let's say I'm a buyer and the market's going up, now the stock's moving away from me. That's a bad thing. Whereas now the market's going up, I'm going to hit support. Sellers are going to come in, smack it down. And that's what I'm trying to learn, as you guys see in my chat every day. It's very difficult for me to make that transition. So I end up chasing stocks, which is what I've been doing for 20 years.
Yeah.
But it was with other people's money. So now, if you think about it, nobody does VWAP trading by hand. So you have algorithms that do that. Everybody can have access to a VWAP algorithm through any broker, Fidelity, Schwab, wherever you trade. I mean, everybody has it. So slice monkeys, as we were called, like me, because we were just slicing orders all day, they don't exist. And that's another form of high-frequency trading. You have, when you put an order in a VWAP algorithm, it's going to slice, going to figure out that volume curve, and it's going to send hundreds, if not thousands, of different waves throughout the day to get you that volume-weighted average price.
Yeah.
And, as technology evolved, and I saw firsthand how it evolved from 1990 up until today, it evolved quite rapidly. So the same concept of a simple test to tell a computer to do a VWAP can be applied to a number of other aspects. For example, traditional index arbitrage. This was big in the early 90s, and all it is gaining the difference between the cash and futures prices. For example, a lot of people say the ES, right, or the S&P 500 future.
Yes.
If you look at the cash price of that contract, there's going to be a spread. Mm-hmm. That spread, that difference in price, is nothing more than, you take the cash price and you multiply it times, 1 plus, the interest you're going to earn until expiration, less the dividends that you're supposed to be paid for that time period. You're going to get a fair value of what that future prices should be. Mm-hmm. And that fair value resets every day. Why? Because every single day, someone's paying a dividend, so that number changes, and interest rates might fluctuate. So every morning, you had a fair value. And what we did is we looked at the fair value, and for example, that fair value was let's say 3. And now because interest rates are at 0, it's inverted. The future's worth less than the cash, which is sort of weird in my eyes. But the future was always worth more than the cash because interest rates dictated that. But for example, let's say it was 3, and you're watching this, and let's say it goes to 4. The difference between the future and the cash is 4 now. You would go out and buy the S&P 500 basket and short the future until it aligned up. And we would do this manually. Now, by the time you hit the 2 buttons, it's gone. So you got computers doing this now. That's another form of high-frequency trading.
Amazing. Well, that information right there was valuable because I think a lot of people, including myself, didn't know. You pretty much know the calculation based on how they determine the spread. The fair value.
Well, it's actually very simple. Anyone can do it. You just take the cash price of the SPX. You multiply that by 1 plus, right? Yep. 1 plus the difference between the interest rate, which is LIBOR, and dividends until, whatever dividends are expected until expiration, you're going to get a fair value.
Yeah, it makes sense.
You're going to get what the future's price. Here, I'm going to post a link here if anybody wants to look.
That's great to know about that. That's good.
Yeah, so basically now there's, I was looking at this last night, and there's websites out there, guys who are selling the service of letting people know what levels program trades are going to kick in, which I think is total BS because, they don't kick in at certain levels. They kick in when the spread widens or shortens. Now, if you look online and do a search on that, there's people that sell that. Right. So I'm suspecting customer. I wouldn't advise anybody to buy it, but take a look at it. It's interesting. I just posted a link.
Yeah, I just look at it. We're going to send out these links later on. I'll take all these links and put them in an email and send them out later. Right.
So basically, again, the high frequency trading is another form. Index arbitrage being automated. So if you think about it, if a machine can be programmed to trade a VWAP, to buy a future and let's say short an underlying basket,
When you say, could you just let me break that down one time? When you say short a basket, short a basket, explain that process, what that is basically when that order goes in.
Well, if you have the fair value that's, like I said before, it's 3, right?
Mm-hmm.
Let's say it goes to 4.
Yep.
In that case, you're gonna be buying the S&P cash, all 500 components, and you're gonna short the future. If it goes to 2, the other way around, then you're gonna short the basket of S&P 500 components.
But I'm just talking about the term basket. What are you referring to as when you someone?
Well, what we call a basket is, by definition, a basket is basically any group of stocks that's more than 15 names and $1 million. That's a definition for the SEC.
Okay, great.
So
thank you.
When they say basket trading, anytime you're trading more than one stock at a clip, for the most part, you could call it a basket. Now, baskets can be conformed of, let's say, there's a lot of ETF arbitrage going on these days. So if you pick an ETF, I don't know, whichever one you want, take MOVE, for example, and you look at the individual components of MOVE,
mm-hmm.
That's a basket.
Yeah.
So that's how ETFs are born, rather than people, the S&P 500, the SPY, for example, is an ETF, but the underlying basket is all 500 components.
Excellent.
At certain weights, right?
Yeah. So I mean, would you be buying the basket, or would you be buying the ETF? Would you be buying as individual stocks or buying it through the ETF?
Well, it depends. I'm going to get the ETFs a little bit later, but basically what ETFs are providing now is another whole different level of arbitrage opportunities, because there's so many of them.
Yeah.
Anytime the underlying components get out of whack with the actual price of the ETF, computers are going to kick in and take advantage of that disparity. Now, obviously, there's a certain market impact that goes into it, because when you go out and you buy the individual components of an ETF, chances are you're going to buy at the market, you're going to buy at the offer, because you can't sit on a bid, and by the time you get filled, the opportunity is gone.
Mm.
So the people who can do this the best are the people who have long positions. They have a book, a proprietary book, and these would be the bigger banks that have stock loan desks. I'm going to elaborate on that a little bit, but if you have a huge prop book, basically you own everything out there, and you want to create a basket or an ETF, instead of going out to the marketplace, you can just pick from your internal book. And what I mean by book is no different than your individual accounts. If you had in your individual accounts all the components of an ETF, and you want to create an ETF, you don't have to go out to the marketplace. You can just deliver all those. You can call your clearing firm, wherever your brokerage firm is, and tell them to deliver them to the fund manager, and they'll send you an ETF. And that's basically how that works. I'm going to elaborate a little bit more on that down the road, because it gets a little complicated. And then I'll also show you guys how there's a way to profit from ETFs when there's a stock halted that's part of it. I mean, you can do a synthetic sort of arbitrage. It's relatively simple.
That's what we want to hear. How to make money.
yeah, I know. I'm trying to learn from you guys, so hopefully there's going to be a nice exchange. Maybe somebody will show me how to trade the freaking ES for once. But anyway, so high-frequency trading, getting back to that, that's another way of doing it. Other examples are ADRs, which are American Depository Receipts, which is nothing other than, let's say, a firm that's domiciled in another country but trades in the U.S. For example, I think Transocean Rig is one of them. Telmex, you have Vale, V-A-L-L-E, the Brazilian mining company, which is huge. It has a huge dividend yield, and they're one of the bigger miners out there. They trade in ADR here. So if you look at the price in U.S. dollars of Vale when it's trading on the New York, and you look at the price in Brazilian real, and there's a disparity, you can do arbitrage between them. Now, there's a foreign exchange market that comes into play there as well. And you got computers doing this all day also. That's another form of high-frequency trading. So if you start adding all that up, units arbitrage, just a simple ways of high-frequency trading, that's a lot of activity that's hitting the marketplace on a daily basis.
Yeah.
It's not necessarily just some, 3 geeks with an evil plan out there that are looking to, roil the markets left and right. There is some of that, but that becomes becoming harder and harder to come by because that space is getting more crowded.
Yeah.
So, for example, as that space becomes more crowded and you get more computers looking at the same setups, as it becomes a self-fulfilling prophecy, it also becomes harder to profit.
Yeah,
you got way too many people coming in there.
That's just talking about that all the time. Once you find something that works so well and everyone starts using it, does it continue to work? And how does it become self-defeating?
Well, for example, yesterday I was watching, a lot of people in the room putting their levels out there, and I noticed that when certain levels get hit, sure enough, they reverse, but sometimes they don't get to that point. There's maybe a quarter point or a half a point before it gets there, it's already reversing. Why? Because who knows? Maybe there's some machines out there that are like, hey, we wait for that number to get hit, we'll never get filled.
Yeah.
Let's just give up a quarter of a point and try to get in front of everyone else. You know, and all of a sudden, eventually, if everyone's people start doing that,
everyone's adjusting.
Yeah. Maybe that's why you see those big wicks hitting the support resistance lines instead of the actual candle touching it.
Oh, there's absolutely got to be something. Yeah, I mean, it's definitely. There's some kind of automation going on that is testing these areas and really fast, fast reversals off of these points, and where they're leaving just wicks. There's no trading. Correct. Yeah, it's amazing when you look back at it and see it.
Yeah. So, well, Gas just wrote, Vander, please make rig bound. So just so you know, I'm long rig as well, and I'm just going to sit on it for a while, but I'm not going to get into that. Just one more thing to mention here on high frequency trading, direct market access, DMA. DMA is, a lot of you guys probably know what it is, but it basically enables the buy side, the retail investor, there's say guys like us, and also the institutional guys, as a way to access the markets directly without having to go through a broker. And the way that works is, commissions have come down. When I started working in the business, we used to get paid 5-6 cents a share commissions. If you get a penny now, it's a lot.
Yeah.
A lot of people pay no more than half a penny. If you get DMA, and I know firms that pay, basically, it's in mils, 1/10 of a penny, 7/10 of a penny per share, then, you don't even want to touch it. Because if you get a human touching it, you got to pay that person, it's not worthwhile. So what you do is you set them up with DMA, and all that is a pipe where the client can enter their own orders directly into the marketplace. Now, what they're going to do is they're not going to enter huge orders or liquid orders to move markets. What they're going to do is enter all the little crap. So, for example, separate managed accounts. If anybody has ever had a separate managed account with a broker, or a mutual fund company or what have you, and let's say Miss Smith walks in one day and says, "Hey, I need to pull out $100,000 out of my account," and she happens to own, to make it simple, a slice of the S&P 500. So she owns all 500 stocks in there. She might own 1 share of something, 5 shares of another, 100 shares of something else. So what is that broker going to do? He's going to just load up all those little tiny orders. He's just going to hit a button and he's going to hit the marketplace. It's just going to go straight down. And for the most part, odd lots don't even make it to time and sales. But if you add this across all the institutions in the country, it can become significant. And I know for a fact some firms program their DMA platforms to release orders at certain time frames. Sometimes it's 3:45, sometimes it's the open, sometimes it's a close. Sometimes they leave them in their machine until they can get a whole round lot or 100 shares before it goes out. But again, that's another form of high-frequency trading. Okay. The guys that actually are sitting there and trying to program and game from disparities in the marketplace and take advantage of illiquidity in the marketplace using computers, they got their work cut out for them. And if they can figure it out, more power to them. There is, and what I mean by that is, look, every year there are guys, and I had the pleasure of working with a couple guys who went to MIT, extremely bright kids. And this is what they wanted to do. This is all these guys talk about, because, they know computers, they're uber smart, they know the markets, they can program, but there's so many people trying to chase the same buck. It becomes very, very difficult, and you can lose a lot of money very quickly. So I would say, to end the high-frequency discussion, is, some of it is bad, some of it's been around for a long time, but for the most part, I think it provides a lot of liquidity in the marketplace. And for those people who are trading off technical levels, like most of the people in this room are, it's actually a good thing. Because if those guys weren't there, those lines in the sand would be nothing. The markets would never reverse.
Yeah.
But you got all the computers that say, hey, when we hit this number, sell it. And, we're all waiting for it to hit that number because we're all looking at the same lines.
Yeah.
And if those guys weren't there, we would probably trade right. Those lines wouldn't mean anything. So they're kind of doing us a service to a certain extent.
Yeah.
I don't think I can blame the high-frequency traders when you have gyrations in a particular stock, or you see 5,000-10,000 contracts print on the ES. I can guarantee you there is nobody out there that's got pockets deep enough to program a computer and let it randomly buy and sell 5,000-10,000 ES. I mean, because it can make you bankrupt in a day or in an hour. It's just crazy. But there are huge institutions and portfolio managers, and I had the pleasure of sitting at dinner in Chicago about a month and a half ago. And it was like 9 o'clock at night, and I'm talking to this guy who's an ex-colleague of mine, and he now sits in one of the bigger hedge funds. He gets a call from one of the owners who wants to hedge his portfolio to the downside. And, he went out and sold something like 1,250 S&P contracts off his BlackBerry at dinner.
Wow.
And he basically, he put into the level where he wanted to be, and he just sat there, and he started getting filled. But then you see the big volume spike, and I know that was him, but it's a legitimate reason. Somebody wants to hedge their portfolio.
Yeah. And
if you're a multi-billion-dollar hedge fund or pension fund or mutual fund, you need a lot of contracts. Those guys aren't rolling the dice. And the guys who do roll the dice, I think they do so, but with much less capital. I mean, it's just crazy to be buying, 1,000 contracts in and out of speculation because, I think we all know it doesn't matter how smart you are, a bit of news comes out in the following second and you get wiped out. Yeah. So, I'm going to move on from that. I'm going to go into Wall Street bonuses, which you wanted me to talk about it.
Yeah, let's break into something. I want to just touch base again. We have Vander on, who's a member of Day Trading Radio, with extensive Wall Street background, and I think the topics today what we're going to talk about, and I kind of put it out there as the gray area, things that you don't get. You hear a lot of you hear a lot of the terms, Wall Street bonuses, end of the year bonuses, a lot of things with portfolio rebalancing, index rebalancing, and another thing, really the window dressing terms. I look forward to going through all these terms with you.
Yeah, I'm going to get to that really quick.
And how we could profit, and if there is a way to profit off of it. You never know. I mean, you being behind the scenes is our first real good view of saying, wow, this is exactly what happens. Why is this not really being discussed? Is it legal? Is it not? Who knows? Continue.
Well, there are ways to profit. There's just a lot of homework involved. And just to let you know, before I get into some of these rebals and how these firms do it, some of the bigger firms, for example, Deutsche Bank, Goldman Sachs, Morgan Stanley, they have entire departments of quants that all they do is crank out data and research on index-type events. And this is all for the institutions who are mainly indexers or whose performance is tied to the index. They're all seeking that extra few basis points of alpha to generate excess returns in their portfolios. Small guys like us, you do enough research, you can find a couple diamonds in the sand here and there. I'll show you guys a little bit later how it works with the Russell, how it works with some ETF rebalance. But right after I talk about the bonuses, I just want to get this out of the way.
Yeah, bonuses.
So, you asked, bonuses, what's up with that? And
Well, wait, give us an example. What is a bonus? Why is Wall Street get bonus so? Why is the bonuses happen and they're so big on Wall Street?
Well, a lot of times, firms need the tax write-off, so they're better off paying that money out to their employees than to put it in their bottom line, because they're going to get taxed on it.
Okay.
So a lot of times, for example, I remember a few years ago there was like a record bonuses at Goldman. There was some ridiculous number, like $100 billion was going out to these guys, and that had to do with there was a sort of a witch hunt from the IRS, and the head guys were being chased after because they were saying that they didn't pay enough in taxes, whatever. So they'd rather just pay it out, keep their employees happy, keep them from going to other firms. At the end of the day, you think about it. If you can hire a guy that's going to generate $1 million for you, why wouldn't you want to pay that guy $500,000?
Mm-hmm.
Because eventually, if you're the guy who's generating $1 million and you're making, $50,000, someone else is going to come along and offer you more money. And so, although some of these numbers are obscene, especially for prop trading, that's all changing now. Because the prop traders at a lot of these desks, they're playing with firm capital, and they're playing with firm capital and getting paid if they make money, and if they lose money, they still get their salary and smaller bonuses.
Vander,
it averages out to all the groups.
Just to back up again, I just want to clarify some of the terms we might know, but I know there's a lot of new traders out there who might not know what a prop trader is. So you want to just touch base on that.
So there's two kinds of traders out there, if you want to call it traders or employees, or maybe three. You have, on one side, you have revenues producers, guys who are actually out there making money, whether it's commissions or profits, whatever, and then you have the cost side of guys. These are the guys in accounting and legal and compliance, and they're not making any money. They're a cost. But it behooves those guys to make sure the guys making on the revenue side can do their jobs and keep them out of legal trouble. So nowadays, with all the regulatory and demands, firms have had to beef up their cost side a lot more than their revenue side, which eats into profits. So bonuses by default get smaller. That's one thing. Now, on the revenue side, you have two kinds of guys, what are called agency guys, which are people like me who basically, if you're an agency trader, you're not taking positions necessarily. You're not playing with a firm's balance sheet. You are trading for commissions. So you're getting an order from a client, and he's paying your commission. If you're a retail trader, a portfolio manager, let's say your mom and pop has some guy at Smith Barney who manages their retirement fund, that guy's making a commission. He's an agency guy. Mm-hmm. If I have, let's say, Wellington or T. Rowe as a client, and he calls me and says, buy me 1 million shares of XYZ, he's going to pay me a commission, penny a share, which on 1 million shares is $10,000. That goes to the firm. That's what an agency trader is. A prop trader doesn't talk to the public, doesn't talk to accounts necessarily. He is just there trying to make money off of markets. And whether that is through having information on the order flow of the company, and or whether that is them going out there and making their own bets, they're going to get paid based on a percentage of what revenue they bring in. There was a few years ago, there was a huge issue with Chinese walls being set up. It's total BS because it doesn't happen. But where the
Chinese walls, what did you say there, Vander? Chinese wall?
Well, a Chinese wall is basically call it a line in the sand between the prop guys and the agency guys, and that's done by regulatory requirements. So let's say you're sitting next to me, Johnny, and you're trading proprietary. You're like you're doing here, So you pick a stock, you want to go long, you want to scalp it, and meanwhile I'm talking to customers, and you hear that I need to buy XYZ, and you jump on it. So what they do is they separate us, whether it's on different floors, whatever. And that separation is called a Chinese wall. But in reality, it doesn't really work, So you got to try to keep it hush-hush as much as possible, because if you're within earshot of somebody who's trading prop, your client doesn't have a chance. And that happens at a lot of smaller shops because they don't have different buildings they can put people in. And it's, you know, it's sort of silly, but, you know, it still goes on to a lesser extent. Now, the bigger guys, the Goldmans of the world, you know, they're very, very closely regulated when it comes to that. But the prop guys have algos to try to sniff out what the agency guys are doing. I mean, it's sort of ridiculous in that sense, but I'm not even going to get into that. But to go back to bonuses, if you're among the few, fortunate few that are going to get paid this year, and this is going to be a really bad year, most likely people are going to get paid in stock. And that stock's going to get vestable in 3 to 5 years. And they do this to tie you down so you can't leave.
Yeah.
So if you're getting, let's say, $200,000, let's say your salary's $100,000, okay, and you brought in $2 million of revenue to the firm as an agency trader or a prop trader, and they say, okay, we're going to give you 10% of that, so you're going to get $200,000. Some might think, well, $300,000 is a lot of money, but if you can generate $2 million,
yeah,
you know, 10% is, I mean, it's small. You might think, well, why won't you go and do it for yourself? Well, you can't generate $2 million of customer business because now you need compliance, you need legal, you need a whole structure. And so what Wall Street provides, it provides sort of like an entrepreneurial type environment where they're taking care of all that stuff and all you have to do is produce. That's the way I always saw it.
Yep.
But, you know, other people don't see it like that. They see it as it's their privilege. So, you know, I had an incentive to go and bust ass, and I was grateful for whatever I got. I never got 7-figure paychecks. I never saw one. I came in, as I mentioned before, right when all that ended in 2000, right before 9/11, and when the dot-com bubble burst and all the other problems of the last decade. And so I kind of missed out. But I don't regret it. It's been great. I learned a lot, and I did all right. So let's say you're getting 200. They might give you 50 in cash. And then they might take the other 150 and say, well, now we're going to give you stock options that are going to vest over the next 5 years. You know, chances are, if the stock doesn't perform, you're never going to see that money. But if you've been there for a long enough period, you have a ton of options and stock tied into the firm, and you just simply can't walk away. And you won't walk away. I know a guy who worked in Merrill Lynch, and I commuted with him over the last several years. I used to take the ferry to C Street to the foot of Manhattan, and, you know, he has a ton of Bank of America stock, and he was telling me that, you know, he got his biggest bonus 2 years ago because he landed a huge new account, and they gave him a ton of stocks that were struck at $17. Now, this one, Bank of America was 17 2 years ago.
Yeah.
And last year, he made less, but they gave him a ton of stocks at $13. It's $5 now.
Yeah.
You know what I mean? He couldn't sell it even if you want,
Yeah.
because, you know, in order for you to get those shares, it has to be within a certain price. The reason they do that is so, you know, everybody doesn't go out and dump the stock anymore.
Yep.
So he's got, you know, his whole livelihood tied into this firm.
Yep.
And the chances of Bank of America getting back up to $20, I mean,
Yeah.
you know, it's not going to happen anytime soon. This guy's almost near retirement age, and, you know, he's extremely concerned because he's got kids in college and what have you. Now, I'm not saying cry me a river, but, you know, it's a bad situation to be in.
Yeah.
If you're a prop trader, for example, and you use firm capital to make money, you basically eat what you kill. If you produce zero, you get zero, and you're lucky if you keep your job.
Yeah.
If you produce, like some guys go out and produce, let's say, $100 million. They put their careers on the line like Corzine did at Goldman, right?
Yep.
And he hit a home run. And, you know, that made his career. Now, the guy before Corzine, if you read about it, blew himself up at Goldman. He put in a big bet, and it didn't work out. And Corzine walked in and, you know, took that portfolio, and he caught the cycle, and it worked out for him. And that's how those guys work. I mean, they live and die by their profit. So if you make $100 million, you know, yeah, maybe you should get $5 or $10 million. I mean, at least I think that would be sort of fair.
Yeah.
It might be obscene in some people's eyes, but think about it. You know, that's $100 million going into the coffers of the Goldman partners. Those guys are going to get paid out, and you did all the work. So this year, I can tell you, I mean, I know for a fact, a lot of my former colleagues, they're already being prepped and being told that, management is just posturing to make it seem like a privilege to have a job when others are losing theirs. They're using the example of MF Global. You guys are lucky to be here, blah, blah, blah. So they know they're not going to get much. And some people are not going to get anything.
What is the performance, when we talk about looking back at the performance in their portfolios and what they're holding, can we kind of segue into that little area? I mean, how important is this last month when we talk about the bonuses? Do people have a chance to get a bonus with this maybe a possible rally this month? Is there
Well, it varies. I'm going to talk about the December effect, which has a lot of that to do with it. But yeah, definitely, it's different for portfolio managers than it is for guys on Wall Street. Don't confuse the guys who are managing your 401ks and your IRA mutual funds with Wall Street. Wall Street is what's called the sell side. These are the guys who are selling security services to what's called the buy side, who are all the mutual fund companies and hedge funds and so forth. So they get paid on a different structure. I've just been talking about the Wall Street guys so far. But, if you want to know how the guys on the portfolio managers get paid, they're going to get paid on performance. And performance is not necessarily them trying to gamble with your mutual fund. They may be tied to certain indices.
Mm-hmm.
The most prevalent is the S&P 500. So if you manage a portfolio, you're expected to match or beat the performance of the S&P 500, after expenses. And if you can beat it by, let's say, 50 basis points, that's huge. Now, personally, I think it's a crock of you-know-what, because if I give a mutual fund company my money and they give me, 20% less at the end of the year and tell me I still beat the benchmark, I don't care about that. I'm about absolute returns. And there's a huge shift right now towards absolute returns from benchmark performance portfolios. But that's, for the most part, how those guys get paid.
Yep.
I'm going to talk about, window dressing, December effect, January effect, which is going to emphasize that. But just so you guys know, the media is going to make it probably seem at the end of the year, that dollars are falling from the sky on Wall Street, because that's what Washington really wants them to do. But a small percentage of people are really going to get what they earn. The rest are going to get hosed. I mean, a lot of people are going to get hosed. And, the other thing that they've been doing on Wall Street is they've moved bonuses from December to February and March. And they've done this across, I'd say, 90% of the firms. The reason they do that, and that sort of kills the December effect a little bit, which I'll talk about in a second. But, that money's not coming into the markets in December, and you're not getting that big, emphasizing that big pop at the end of the year.
Yeah.
But when you move it to February and March, what it does, it makes it harder for people to leave a firm. You kind of like tie them down, because on top of that, if you leave, there's something called a garden leave that they hold you to, which means for the next 90 days, you are not allowed to work for a competitor. So imagine you get your bonus in March, you walk out, and now you have to sit on your hands for 90 days. Now it's, midsummer. Nobody hires in midsummer, plus you just lost half a year. They're making it very difficult. It's sort of unfair, but, it is what it is. It's not what it used to be. So, I'm gonna move on from that. With regards to, I'm going to talk now about, rebalances and why they're so damn important. The daily market on close and rebalances, which I post.
That comes. Tell us a little bit about that. Let's break that down a little, because daily on market closing and balances. Now, what is that? Right. Break that down. Is that we're talking the Dow Industrial stocks?
Well, the daily market on close rebalances are posted by the New York Stock Exchange.
Yeah.
And basically, what it is these are imbalances between buy and sell orders for the close. A lot of pension funds, indexers, mainly indexers, their portfolios are benchmarked every day, are priced. I mean, when you go and you look at the price of your mutual fund, let's say, at the end of the day, it's a static number at day end. And what they try to do is they try to mimic the closing prices as much as possible. So a lot of these guys only trade at the close. So the imbalances are out there to serve as a guideline as to, what direction the market might be moving into the close, and also to let people know, if there's a humongous buy imbalance and you have to sell, and you missed the 345 cutoff, you can send that sell order flow, and it will pair off against the existing buy.
Okay, yeah.
So 345 is the cutoff to enter a market on close order. You can enter it after 345 only if you're on the opposite side of that imbalance and you have a matching trade. And that's basically why they do it. So a lot of times, these things are categorized in 10 sectors and are published as such. It's, consumer discretionary staples, energy, financials, healthcare, industrials, tech, materials, telecom, and utilities. The financials are the most important one. The financials usually predict, where the rest of the market's going. And they've been the sector to watch for the most part.
Let me ask you a question. There's a room is there an area to get this? Where do you get the information, closing imbalances? Is there a website, or is there any how do you get that up to date?
Well, the New York Stock Exchange has on their website, and I should have put the link, but I don't have it here. Actually, I do have it here. Hold on a second.
Excellent.
Put this link up there so people can look. And I think there's basically an article about it. But if you go to the New York Stock Exchange, there's a lot of information on the imbalances. Basically, you have to subscribe, and it's a feed. And what it does is it feeds into your spreadsheet.
Okay.
And your spreadsheet, you can do the calculations. Now, most Wall Street firms have this feed. I used to have it. And the spreadsheet is then sent out to all the clients. And the clients will look at them, and they'll compare them, and they'll know what's going on into the close if they have something to do. So, for example, right? Let's say the imbalances come out, and all the sectors are sells, except financials. Financials are buys. Well, what does that tell you? That tells you that there's rotation going on. People are buying financials and taking money out of everything else.
Mm-hmm.
That's important information in the last 15 minutes of the day.
Yeah.
So a lot of times the way I look at it and I use it is when the imbalances come out, unless they're greater than 400 or 500 million net, because you're going to have a buy and a sell, and when you match the two, the difference is what matters. If you have a big one, it's going to move the market, all right? If it's around 150, 200, like it was yesterday. I don't know if you guys noticed yesterday, I posted an imbalance of 180 million shares on the sell side. And although it's not a big number, I'm thinking, well, in the absence of liquidity,
yeah,
the marketplace towards the end of the day, because it was really dead.
Yeah.
It's going to trump anything else going on. And the only thing that could counter that is short covering. But since the market was, up, I think anybody that was going to short cover it already did. So I went all in and I shorted the market, and I got lucky, and it went down, and then towards the end, people covered those shorts because I'm sure people who see it's a sell imbalance, they're shorting the market too. It's a personal call, but it's very valuable information for the way I see it.
Yeah, I mean, the profit off that, you say when those numbers come out and there's a big imbalance on, say, just Goldman Sachs or a bank, or is it going to be a basket of stocks, or is it going to be individual? It'll be individual.
It can go down to the individual level, but I just get the sectors.
All right, so you're getting the sector.
Net number per sector.
So you see
when I post it, I'm sorry.
No, go ahead. I'm just saying. Go ahead.
So when I post it in there, I'm going to say, for example, there might be 100 million to buy amongst all 10 sectors. This is all the buy orders they got. And then they got sell orders for 200 million on the same sector. So if you take the difference of the two, it's a net sell of 100, right?
Yeah. So they have more.
I'll post net sell of 100, and then I'll put, whichever one number sticks out, usually the financials.
And how do you, do people profit off of that? When they see that hit the floor, do floor traders jump on that, or do...
Well, if you notice, every day, every single day, without exception, at 345 on the dot, that market is moving in one direction or the other. Yeah,
it is. So again,
right?
Now,
I'm not getting that email until a couple minutes afterwards because, I'm asking my buddies to send it to me. Now it's going through email by the time I get it.
Exactly.
So they got to make the email. They get the data at 3:45. It probably takes them 30 seconds to a minute to drop it in the spreadsheet, format it, save it, shoot it out, it'll probably take a minute or two by the time I get it, you know.
So yeah, it's just another, you know, another chain of people to have to go through, and I'm sure people profit off of that chain.
Yeah, for the most part, it indicates, you know, the direction. So, but again, you know, if anybody wants to subscribe to the service, you could do this on your own. You know, you just go to the New York Stock Exchange website. I don't know how much it costs. I've kind of taken it for granted. It was always been there for me. But, you know, you got to do your homework, man. And there are ways to profit. Now, I can tell you, Wall Street banks, they could give a crap about the ES. They're not sitting there waiting for that imbalance to come out to trade with one future or two or three. It's not important to them. They're doing it to let their clients know what's going on in the marketplace, and trying to attract more order flow to offset that imbalance. You know, so if you can send that out and you get a big fish who says, oh yeah, you know, I was sitting on, let's say the imbalances were, you know, a sell of financials, you know, that's really stuck out. A guy's like, hey, I'm sitting on, you know, $100 million of, you know, I need to buy financials. See what you can pair off. And now you got a huge order, and you're going to get paid a commission for that.
Yep.
And that's why you do it. That's why they do it, at least.
Wow.
So that's the daily MOC, and I put a link out there for people to look at. You know, month-end rebalancing. Now, month-end rebalancing every single month of the year is very important. And why is it very important? Because many public pension funds, they all have mandates to rebalance at month-end, so that during their committee meetings at the beginning of the month, they all have them, they can look at a clean portfolio. You know, they can basically, they won't have, let's say during the course of the month, one stock totally outperformed the rest. You're not going to have that skew when they're looking at it. You know what I mean? You're going to put everything back in line according to that, how they should be. You know, the board of trustees and committees, they force rebalancing in order to align their goals with benchmarks, so they can post the stuff, get prospectuses out to clients, so they can see what the holdings are. You know, there's a lot of filings that they have to do, 13D filings. So they have to do this at month end. The interesting thing with month end is, and there's a lot of research on this, and I'm going to post another link on this, on an article I found. There's definitely an inherent bullish bias as we approach month end. Yeah. Why? Because there's more buying activity than selling. And I'm not talking about individuals, scalpers, or like us. I'm talking about, there's a time of the month when 401k contributions come in, IRA contributions come in, postings to let's say, savings accounts from people's paychecks, reinvestment of interest in dividends. Dividends, if you notice, most of them get paid in the second half of the month or towards the middle of the month, you know, but the actual payday is towards the end. So all that, if you add it up, is buying. And there's an inherent bullish bias. I mean, it helps push the markets up. And I read a paper that basically said, you know, you go back X number of years, and you look at, you know, by day of the month, the performance overall, you know, the last 10 days of the month totally outperform the rest of the month.
Yeah.
There's always going to be an inherent bullish bias. Now, just to give you an idea of the size and magnitude that any one of these funds can have on the market, and I'm talking about month-end rebalancings, you know, every month, especially November 30th. This is like the most important month-end of the year, by far, because it sets the tone for December on many levels. Just to throw some numbers out there, and these are guys who I've traded with in the past, and when they rebalance, they move stuff.
So,
I'm sorry?
So you've been involved. Have you been involved in rebalancing?
Yeah, that's basically a good portion of what I did on the portfolio desk. You know?
Yeah, so...
You send all this information on index changes, and, you know, Russell rebalances, MSCI rebalances, what have you, because, you know, if you give them good enough information,
yep,
they have to go to a broker to trade this somewhere. They'll spread it out among all their brokers, but if you get even a small chunk from a huge fish,
yep,
it's size. I mean, it's significant. You know, one of my bigger clients, I mean, we had several, but, you know, Florida State Board of Administration, they got $143 billion. CalPERS, $265 billion, which is the California Public Employee Retirement. California State Teachers, $160 billion. General Motors, $130 billion. Texas Teachers, $120 billion. I mean, it just goes on and on. But
yep,
when you got that much money, and let's say CalPERS in particular, they have a small cap portfolio that's worth about $65 billion. And when the small cap portfolio manager decided, hey, listen, I want to buy ABCD, you know, it's a new up-and-comer tech stock, and liquidity is kind of like crap. He wants to buy, I don't know, $500 million worth. I mean, it's a lot. That's going to move that stock over a period of time. Chances are he's not going to do it in one day, but it's quite significant.
Yeah.
A lot of people overlook that there's a huge money tied into the marketplace, and when these guys decide to do something, they move. And usually they'll do it at month end.
Month end.
I used to trade, for example, for a sovereign fund called Government of Singapore. These guys have over $100 billion now. And these guys, you know, they weren't tied to any index. They just threw it around. I mean, they threw basically huge money around, and they made a ton of money. They took humongous bets and humongous risks. But when that phone rang, you knew something was going to move. And so we had to get not even a phone number, a direct wire to our desk, because if that phone rang and the whole floor saw the lights, because we all share the phone system, everybody saw that number that was Government of Singapore, the whole room would go quiet because everybody knew I wanted to hear what my conversation was with these guys.
Wow.
It was going to basically move whatever they decided to buy or sell. So, you know, it's quite significant. Just to mention, the end of month activity that's going on today is extremely important. It sets the tone for end of year levels of compensation, not just on Wall Street, for the money managers as well. You know, companies, corporations, they get paid on their stock performance. That's why you're going to see so many buybacks and stock repurchase plans being announced in the next month and towards the later part of the year. Some of them went out today, actually, which is not a coincidence. It's not like, you know, the market goes up and they decide we're going to do a buyback. You know, they got to have a board meeting. It has to get approved. This was all premeditated, you know, that they're going to announce it on the 30th.
Let me go back and just cut in for a second and just ask you a question based on the end of the month buying. You say today is an important day, being the 30th. Does it always happen on one more particular day than the other, or is it go the last week, or is there somewhere we're really looking on the 30th?
I'll tell you, it happens on the 30th for the buy side, being the portfolio managers, pension funds, indexers. They have to get that closing price from the 30th, the month-end price. Now, the game is played as follows. Wall Street knows that these guys need to own stocks, say, A, B, and C, let's say, at month-end. So what they go do is they do some analysis, and I'm going to share some of that with you down the road on, for example, S&P changes, Morgan Stanley, whatever indexes might be rebalancing that day. The MSCI is having a big one today as well. So you do your due diligence and you figure out
what they need
which stocks are going to be moving, and what they do is they buy them ahead of time.
Yeah.
And they buy them in the days leading up to the 30th. And why do you do that? Is because two reasons. Number one is, by the time the 30th rolls around, you know, that stock already got propped up. You got a nice built-in profit.
But they're going to get that extra pop, yeah.
Now you're going to sell to that client from your inventory.
Yep.
Okay, and you're going to make money there. And number two, and more importantly, you can offer them deals. So, for example, I still have a few clients who are indexers. They just follow the indices. Now, when they need to buy a certain name, you know, they're going to shop it around. Goldman might come to them and say, listen, I'm going to pay you 2 cents better than the close. So whatever the closing price is, they're going to get 2 cents better.
Yep.
And that's alpha for them.
Yeah.
And Morgan Stanley might say, well, I'm going to give you a nickel better than the close. Now, if you're a small broker-dealer and you don't have a prop book, you can't compete with that.
Yeah.
You know? You just can't compete with that. So they'll give you something else. They'll throw you a bone, but they're going to send that order to the big broker who's going to give them a nickel better in the close. Now, how can they give them a nickel better in the close when they're only paying, let's say, a penny commission? Is because Morgan Stanley, they might have $1 built in profit because they've been buying it up for the last week. You see what I mean?
Yeah, absolutely.
Right. So it's also a dangerous two-edged sword because, you know, if Morgan Stanley knows that they have, you know, X number of clients who are going to come to them and half of them go someplace else,
yeah,
now these guys have a long position in the stock they don't want.
Yeah.
and they're going to go out and dump it. And that's why you'll see a lot of times these huge gyrations up and down.
Oh, it's amazing. I just want to touch base on that, you know, and it's I remember the last time I think it was the Russell rebalancing, and we saw some of these Russell stocks.
Yeah, that's why you see that.
And, I mean, it was wild, and it came at the end of the day mostly, you know, right at the last.
Yeah, that's exactly why.
So that's when we should really pay attention to the end of the last 15 minutes of today. You're going to see.
Well, you want to pay attention to the last 15 minutes, and I'm going to throw out some specific names of things to watch. I'm not saying for anybody to buy them. Just watch, because a lot of times I think what happens is, you know, if you're involved in a stock in the days coming up, and you don't know that there is one of these events going on, and your stock starts going up $1, down $2, and you get your ass handed to you. Now you're thinking, oh, it's high frequency, guys. It's manipulated. It's not. It's just happens all the time. You just have to know that this is going on.
Yep.
You know, it's pretty. You know, it's all about information. You just have to be informed.
Exactly.
And there's a lot of sources of information out there that you know, people should read. And I'm posting several links here. I'm going to put one more. This is on the month-end bullishness. Here we go. That's a very good article, by the way. So, you know, now that you talk about the Russell, that happens once a year. It used to be a huge game. It's not as much. And I used to trade this for the firm's books and place my own bets, and I did okay for them. They didn't give me squat out of it, but, you know, I learned how to do it. And the way that is played is the Russell Rebal. There's two main indexes: the Russell 1000 and the Russell 2000. All that is if you were to rank all the stocks out there, U.S. based, domicile, there's a bunch of rules, but you take the first 3,000 stocks and you rank them by market cap based on float, not shares outstanding, but float. And you draw a line between 1,000 and 1,001. That's your Russell 1000. And then you go from 1,001 down to 3,000. That's your Russell 2000 index.
Gotcha.
There's a lot of small cap managers that follow these indices religiously.
Yep.
I know Cal Sturz, for example, follows the Russell 1, religiously. So most of the S&P 500 components are part of the Russell 1, because they're, you know, some of the bigger stocks.
Yeah.
So by default, they got to follow the other one too.
Yeah.
And but they rebalance once a year. There's smaller, you know, adjustments that go on, but the big reconstitution occurs at the end of June every single year. It's widely followed, and it's something that people could really game if they wanted to. Now the game that's played is to figure out which stocks are going to be going into the Russell 1. There's 5 categories, right? There's new stocks being added to the Russell 1. These are companies that were never in any index, right? Let's say when Google had their IPO, you know, they appeared on a thin air. They have a huge market cap.
Yep.
They're going in.
Yeah.
That's a straight buy into the Russell 1. Those are if you get 5, that's a lot. Then you got straight names into the Russell 2. These are small cap companies that have performed very well, and all of a sudden, you know, they've moved up in the world, and they're going to get added. Those usually pop very well too.
When you say pop, you pop it in the rebalancing. So these are ones that are not yet in the or not yet added, or just they're already added, but you're going to still see.
They're not in the index.
They're not in the
index. Yeah, they're going to come in. So they're going to get the most. They're going to get a lot of dollars. A lot of indexers that need to own these companies.
Yeah.
So they have to buy them. You know what I mean?
So you got to pretty much just do a little research, figure out which stocks fall into that market cap and which ones are on the performance sector for that.
So for example, I know I haven't done this in several years, but the last time I did it, I think the cutoff was $170 million for the smallest component of the Russell 2, right? So when you rank them, any company that, let's say in April of that year, they were worth 250 because the year before they were only worth 100, you know, and they came up. Now that's going to go into the Russell 2. You don't have to wait till the end of June to do it. You want to start buying it as soon as you can, because as people start figuring out that this is going to be a component, it's going to start going up.
Interesting.
So there's, you know, and I'll briefly describe to you the process. So, you know, within the 5 categories, you got, you know, the new ones to the Russell 1, the new ones to the Russell 2. the ones that are migrating from the Russell 2 to the Russell 1, you know, they're being graduated because they grew. The ones that are being demoted from the 1 to the 2, and then the ones that are being dropped altogether from the Russell 3, those are going to get smoked.
All right, now let me ask you: is there a voting process on this, or is there a?
No. There is no voting process on it. The way I did it, when you have to kind of like do it from scratch.
Yeah.
There is a methodology out there, and I'll post these links as well so people can read about them. There's papers, all kinds of stuff. But the way it's done is you start with a clean slate. You take the entire universe of stocks, okay? And you go to the Russell website, and it tells you what gets included and what doesn't get included. So anything under $1, you got to drop. Limited partnerships get dropped. And there's all kinds of different, rules to come by. And so then once you have what's left over, you're basically going to rank them by market cap.
Yeah, all right.
And then you're going to compare that to what's currently in the index. And that's going to give you a good idea of what's going where. You know what I mean?
Yeah.
So it's a lot of work.
I bet there's firms out there that specialize in this. You could probably just buy the research.
Yeah. Look, I'm gonna post some stuff out here for the methodologies.
Post away. This is
so
good
people
stuff.
People can read, and I'm telling you, it's a lot of work. And I am surprised that there isn't a website out there. And this is an idea for you or any of you entrepreneurs. I'm simply not doing it because I was the guy stuck with doing all this grunt work for many years.
Yep.
And I never want to do it again in my life.
But your surprise is all right.
So that's 2, and let's see, this is 3.
And again, I want to try to remember. I'm bookmarking all these too, so I'm going to send out a follow-up post with these links to the members out there.
Yeah. So I'm kind of surprised that there isn't a service out there that would actually sell this information to subscribers. You know what I mean?
Yeah.
Traditionally, like I said, all the bigger banks have an entire department that all they do is this stuff. That's all they do, And those guys are like money to the big institutions. Now, when I did it, obviously it was something for them to compare it to. They appreciate the effort. I was sending it more out to hedge funds to let them know, if they wanted to place their bets, which stocks are going to move where. But I wasn't getting the big orders, and I couldn't compete with, an entire team of quants from MIT. I just can't do it, But a lot of times, I was like 95% correct on what's going in and out. Mm-hmm. The way that game is played now is before they were doing it in May. So in May you started your clean slate, trying to figure out what's going in and out. You take your positions, you hold them for a month, you dump them.
Yeah.
Now in December, people are starting to do it. Because they're looking at, well, if I can predict now what's going in 6 months from now, and I can get that January effect or whatever, people are taking their positions then. So it's not at the people who are trying to game it on the 30th are getting smoked.
Yeah.
Stocks are going the wrong way. There's all kinds of crazy stuff going on.
Yeah. They're selling into it.
I wouldn't wait till the end of the day. If you really want to play this game,
well, let's take a look at those.
I'm sorry.
No, I'm going to say you're going to mention a few stocks to keep an eye on.
Yeah. Well, I'm talking about the Russell right now. It happens June 30th, right?
Yep.
Then just moving on. I'm getting now to the part where I'm going to tell you guys about window dressing, December effect, January effect. But ETF rebalancing. There's a site out there which is called Index Universe and a couple other ETF sites. They have a calendar that will let you know what ETFs are rebalancing when. ETFs are more prevalent now than they've ever been, and as such, they need to rebalance their holdings as well. And sometimes, they come up with significant flows that will definitely affect certain stocks in the markets. And even when I was sitting at my last job, unaware that this was going on, we're sitting there going like, well, what the hell's going on with this stock? You're calling specialists, you're calling the bigger holders, or like, we don't know, and all of a sudden it turns out that, I don't know, let's say Pro Funds or Direction with the inverse leverage ETFs, whatever, they did a rebal. They didn't tell anybody, but it was huge. There's tremendous dollars that are following this.
Yeah.
So now everybody's paying attention to those. And I think there's probably more of an opportunity to be had with an ETF rebalancing because it's not an exact science yet. You know, it's like it hasn't been gained to the point where there's no juice in it left. So if people do their homework, and again, I can't tell you the best way to do it, but I will tell you this about ETFs. There is a way to arb an ETF very, very easily when you have a halted stock, and I used to do this. I started doing it actually for the last couple of years, and it worked pretty well. So, you know, basically when you have a stock that's halted, stops trading in the marketplace, let's use as an example Yahoo. I know everybody's been looking at it, including yourself, Johnny, as a takeover rumor. And you know one of these days it's going to be halted, and you know why, because they're going to announce somebody's buying it, right?
Yeah.
So take that as a perfect example. Boom, Yahoo's halted. Now, you know, you have a good inclination that when it opens, it's going to open much higher. So you figure out what ETFs it's trading in.
Yeah.
So all the ETF is a portfolio of stocks that make up that ETF. Yahoo's going to be one of the components. The ETF is going to continue trading in the open marketplace.
But it won't be affected by
Exactly. It's not going to be reflecting the new Yahoo stock price. Actually, it's going to be reflecting the Yahoo price as of the time it was halted. Right? So what we used to do for clients is sit there and say, listen, you want to go long Yahoo? Fine. You can't buy it in the open marketplace. So what do? Is like you arb the ETF, you know? You buy the ETF and you short all the other components within it except Yahoo. What you guys can do is just buy the ETF outright.
Yeah.
Because when Yahoo opens and it opens much higher, that ETF is going to pop.
That's a great thing. I mean, it's simple enough. Again, I guess you just have to, you know, what they say is you have to have your ducks all lined up, and you got to be on top of your game when this happens. When they get a halt, you got to know where to look and how fast to look. And I mean, I'm sure other people, if you know, I definitely thought about that concept. Like I knew that the baskets, you know, you get a halted stock, it's going to affect whatever index. Even in the case of an index, if you got a halt in IBM and it popped, you know, the index would pop on it in that type of way. But how fast do you need to be to catch the, you know, you probably are going to see a quicker reaction into the ETF, you know, so we have to be real fast on measuring that out.
Well, I would say as time goes by, it's going to get harder because more people are looking at it.
Yeah.
But right now, ETFs, I mean, they're popping up left and right all over the place. And maybe, you know, Yahoo's part of, you're not going to necessarily be able to game it on the bigger ETFs.
Yeah, but you can
Yahoo's part of probably, like, I don't know, they're probably part of 25, 50. I have no idea how many.
You're right.
The smaller ones, you know, the smaller ones that are less liquid, because if you're an institution or a big broker and you want to throw millions of dollars at it, you're not going to buy an ETF that, you know, doesn't trade well because you're going to move the ETF by default, right?
Yep.
You need to flock the liquidity, but whereas you or I can go out and buy 100 shares and we're not going to move it, right?
Yeah.
That's basically something to look at. But, you know, like everything else, you just got to, like, be prepared. You know, I think Yahoo's going to be bought out at some point. I don't think they're going to halt it during the day. They'll probably halt it at the end of the day. But if they do halt it during the day, you know, it's like, yeah, buy any ETF that contains Yahoo, and I think you should do okay.
Yeah, and that goes with any other stock that might be a big stock that might have a big weighting on an ETF.
Correct.
Great tip there, Vander.
Not a problem. I got more coming. So
good.
I just want to run through this because it's already been, what, an hour and a half?
Yeah, you know what?
I don't want to bore anybody out there.
No, you know, this is information. Like I said in the beginning, when we get information that we don't normally get, it's invaluable to us, and I appreciate it. So you have the mic as long as you want it, or as long as we could, you know, enjoy it.
All right. So one more thing regarding the month-end rebal. I just wanted to throw out there that, you know, it's really no coincidence that I think today that news came out this morning. As I wrote in the chat yesterday, because this is such an important date, the market would have faltered today, and you don't get a lot of cash that's on the sidelines buying into the market because they're scared. And the market doesn't rally in December. It's bad for everyone. It's bad for the economy. Bad for guys on the buy side. It's bad for the brokers.
Exactly.
No one wins. I think they timed this announcement knowing damn well that this is a very important day, and it's going to probably set the tone for next year. If December is a good month, is going to set the tone for next year. If December falters, it's going to be a disaster.
Isn't it amazing, though? Isn't it when you look back and just make that statement saying, you know, a timed release? I agree with you 100%. You know, this market.
Incredible, yeah.
You know, there's some idiots definitely out there, but if you have any sense of what goes on in this world, you know that, you know, the markets, pushing the markets in the right direction is going to cause, you know, certain things to fall into place. And this was one of the this perfect timing, huh?
Yeah, I think personally this is kind of like a little overdone. When I see 25 handle candles on my charts, I don't even want to touch this. You know, it's weird, but you know, that's just my opinion. The other thing about this month-end thing is, I can tell you this about indexing. You guys remember when Lehman collapsed, Bear Stearns, all that stuff, and Citigroup went down to $1, and it was incredibly important for Citigroup not to fail. I mean, the government, everybody was, all you heard about was Citigroup talk every single day. It's at $1.10, it's at $2, it's at $3, it's at $4. And why? Because they needed that stock to close above $5. Why? Because at $5, it becomes eligible for inclusion in the S&P 500, which it once was.
Okay.
Now, this is the backbone. It's a huge institution, one of the backbones of the American financial industry. They could not afford for it to fail. And they propped it out to 5, and the day it closed above 5, they did the reverse split.
Yeah.
And then the following day, S&P announced it's going into the index. Now, that's very convenient, and that was like a slam-dunk trade for anybody on Wall Street who knew. I mean, some people, they loaded up on this thing at $1, $2, $3. Everybody knew it was going to go to 5 because they couldn't allow it to be out of that index.
Yeah.
And I think that holds true for Bank of America.
Yeah.
Now, the reason I mentioned that is the Bank of America was almost at $5.
Yeah.
As of today. Now,
and it was yesterday, right? With the downgrade after market, probably was after market.
They can't. You know, it would be extremely bad for Bank of America to get dropped from the S&P 500. Number one is just the name.
Yeah.
If you heard Bank of Germany or Bank of Japan gets dumped, you know, it sounds like the whole government's going down the drain. You know, we know better than that, but in the world view and the world's eyes, Bank of America has a huge institution. They got way too much at risk. You could say they're too big to fail, but more importantly, they're not going to to be allowed to fail.
You know,
and
just
the first step towards failure would be for them to get dumped from the S&P 500.
Yeah. I agree 100%. You know, Bank of America, you know, like you said, it has America in the name. It's just something that, you know, just like anything else, there's certain brand names out there that mean a lot more to stick around just for the psychology of the markets too. I mean,
yeah, absolutely. And also, I tend to think, you know, if Buffett stepped up to the plate and bought warrants at $7.10, maybe he was doing a favor to Obama. Who knows?
Yeah.
I think he's going to get paid at some point. You know, I personally detest Bank of America. I think they do a horrendous service. I got their credit card.
Oh, yeah.
And I've had to deal with them with more. They're just awful. They're just freaking awful. But they're not going to be allowed to fail. I really don't think so. That would be humongous. It would be a domino effect, and it would be the biggest domino.
Do you think? You know,
so that's another reason probably why I don't think this thing's going to go below $5. You know, and also why that timing of that announcement was so important. You know, it was just, you know, B of A at $5, November 30th. They got to announce something. You know, you got December right around the corner. The markets were trading, you know, they're very fragile. I mean, this thing could have been down $50 if they didn't announce that. Who knows? 50 points, I mean.
Yeah.
But anyway, I'm going to move on. Let's see. S&P changes and quarterly rebalances. I already think I mentioned that. Just so you guys know, there's about $1 trillion of money that follows the S&P 500. And what I mean follows is, if you look at like the Vanguard S&P 500 fund, or the Fidelity S&P 500 fund, or T. Rowe, or Wellington, or Putnam, all these big funds that have their own mutual fund tied to the S&P 500, and you add all those dollars together, there's about $1 trillion. There's about $65 billion to the mid-cap 400 and $25 billion to the small-cap 600. So they're not as significant, but that doesn't include ETFs. That doesn't include the SPDR nor any other derivative of an ETF that is traded on an exchange tied to those indices. So when these indices announce changes, whether adds or deletes, or share changes or adjustments, it's huge. They also do a quarterly rebalance in March, June, September, and December on the option X, and that's, you know, since it's a market cap weight index, which basically means if a stock goes up in price, its market capitalization is going to go up because it's a shares times price. And if another one goes down in price, you know, its weight and market cap is going to go down. So once a quarter, what they do is they even everything out. People are going to have to come in and sell the one that went up, you know, to bring their holdings back down in line, and they're going to have to buy the one that went down to bring the holdings back, to even everything out. You know what I mean?
Yeah.
If there's any particular corporate action, merger acquisition, share change, let's say share repurchase plan, or maybe they're floating more shares, a secondary, whatever, and it's over 5% of the outstanding shares of the company, they will make that change and adjustment outside of that quota of, you know, once a quarter. They'll either do it at month end or they'll do it at random throughout the month. You know, they will announce it a couple days ahead. There's an S&P website out there. I think it's called Index Alert, and, you know, we used to subscribe to it, and it announces when these changes are happening.
We have that website?
You know what? I don't have the link. I can post the link later on.
All right. Yeah. Great.
I don't. You know what? For whatever reason, I don't have it. It's Index Alert S&P, and they also put out the methodology of how they do the quarterly and so forth. You know, we used to put out spreadsheets just like we did for the other indices and send them out to the customers. Once again, it's significant, and I'm going to give you in a little bit some specific examples of some stuff going on today. So I'm gonna move on from that just to get going. You have the MSCI. Let me post these links to the MSCI rebals so people can look at it. I'm not going to go in detail because it's just huge. And let's see.
I have again, Vander, I do have some questions from people, but I want to save those for the end. Towards the end, we got a lot of members that send in some emails and questions.
Yeah, I'm almost done here. Hold on a second.
Oh, take your time. I mean, I'm just letting you know that I think everyone's really glued to the seats listening to you, bringing great knowledge to the thing. You know, just information that you really, again, I think is like the inner workings of Wall Street, whereas the you know, the small fish on the outside of it.
Yeah, you know, but you know what? A lot of times, like I said, you know, there's some games that, you know, you can't compete with at their level just simply because they have these deep pockets. You know, it's like going up in front of a casino and thinking you're going to do better than them. You know, you're going to keep playing until you run out of money. The casino never runs out of money. So basically, but there are things you can do, and you have to do your research. Put the work in. You have to do your research. You have to do your homework, and you have to try to get the information. And even that doesn't guarantee that you're going to make money. You know, I mean, at the end of the day, it's a crapshoot because, like I said, if you have a index event and everybody needs to buy a tremendous amount of a certain stock, but in the days leading up to it, all the brokers already loaded up on it, and now they have excess shares, they're going to dump it, and that stock's going to go the other way. And that happens a lot, actually. And I think Wall Street banks have been so desperate for profits in the last couple of years that, you know, they take bigger and bigger risks with things like these index events because it's sort of like a low-risk trade because you know there's going to be volume and you can justify it as to why you did it. It's not like just rolling the dice. But you know, some people get burned really bad. I mean, really bad. Yeah, well, even the institutions. So those are the links on the MSCI rebalances. I'm gonna move on to now window dressing. You wanted me to chat about window dressing? Oh, absolutely. So, what is window dressing? It's simply when the portfolio managers make their portfolios look better by getting rid of losers and buying winners. Mm-hmm. So, to give you like a perfect example, let's say you're going into year-end, or let's say month-end, and you have a stock that really dumped on you this month. You don't want to hold that in the portfolio going into that committee next week. So what do? You get rid of it, and you redeploy that money into something that's going to make you look good.
Okay.
Because most of the time, the investor's not going to know when you bought it, what price you bought it. You just see the holdings. When you go to buy a mutual fund, you just look at the holdings. What do they own? You don't know what price they paid for it.
Yeah.
The price is reflected in the price of the mutual fund, right?
Yeah.
And that's basically it. It's that simple. That's window dressing. Now, when people do window dressing, is it depends on their mandates. It's not illegal, and a lot of times these guys end up paying top dollar for the winners, and they sell us at the lower lows on the losers.
Yeah.
Which doesn't do their fund holders any favors. But as we all know, who trade day in and day out, sometimes the hardest thing to do is to take a loss on a stock because we always think it's going to come back.
Yeah.
And the reason they do these rebounds and the reason they have specific rules for portfolio managers is to avoid that from happening because they commit those mistakes too.
Yeah.
So as time has gone on, there's more and more rules restricting what portfolio managers can do. And I'm talking about buy side now. I'm talking about mutual funds, pension funds, hedge funds. There's more guidelines for them to do, so their jobs become more plain vanilla. And all they got to do is keep their costs down. So they're trading less frequently. And they're basically being told how to trade and what to trade. So a lot of the thought process goes out of it. I know a guy at Invesco, for example, a good friend of mine, really smart guy. He manages one of the bigger portfolios. And he gets paid well, but he says it is the most boring job ever. So, for example, the committee tells him, beverage companies, you're only allowed to own, Coke or Pepsi, let's say. So he's got to choose between Coke or Pepsi. So sometimes it's Coke, sometimes you can't look at the others, right? Because they're too small, they're too risky, they don't have the balance sheet, whatever. So they're basically telling him, pick from all these categories, A, B, or C, and they're doing the job for him, At the end of the day, he's got to figure out how to at least perform to the index, and he gets paid on that, but it's one of the bigger the fund, the duller the work that goes into it, but they still move markets. And that's basically it for window dressing. There's really not much else.
Well, is it more window dressing you come at the end of the quarter, basically?
Well, usually at month end you get window dressing.
At month end.
Because at month end, let's say like today, if you have to rebalance your portfolio, what are you going to do? You're going to get rid of the underperformers, and this is a good time for you to get rid of the underperformers and buy stocks that you think are going to do well.
Yeah.
Unfortunately, a lot of times it's a mistake because you're selling stocks at the low after they already got sold.
Yeah, absolutely. Yeah.
You know what I mean?
Yeah.
So, and when you do it in December, that's when you get the December effect. Now, that's what I'm going to talk about next.
Okay.
Year-end window dressing is a little bit different because it's more focused on independent wealth advisors. What I mean by that is, we haven't talked about the retail side of things, which is huge. The breakaway the guys who used to be retail brokers at Merrill Lynch, and now the guy's got a corner office at some little shop, Jones and Company, or whatever. Everybody knows somebody like that. Independent wealth advisors, registered investment advisors, which means they just have more than $25 million in assets, separate managed accounts. This is their once a year. This is their big chance to turn their customer accounts. So, if you traditionally had a broker that dealt with, your grandparents' accounts or your parents or maybe yours, a wealth advisor, they're not going to be calling you throughout the entire year that often to tell you get rid of everything, rebalance your portfolio all the time. They do it at the end of the year. And why do they do it at the end of the year? Because let's say if they got you into Eastman Kodak last year, you got a humongous loss.
Yep.
And there's no reason to hold it into next year, Dump Eastman Kodak, and you're going to have that big loss that you can offset against any other winners, right? So now you've got a chance to tell you, well, get rid of Eastman Kodak, but also you've got all these profits built in all these other stocks, sell those too, and that way you don't have the tax liability because it offsets each other. So now he can sell you other stocks, right?
Yep.
To get into. And this is how they make their money at the end of the year, how they window dress their client accounts. And there's nothing wrong with it, but, you know, at least they're not churning their accounts all year round. December is huge for them, especially towards the end, between Christmas and New Year's. That's when you get a lot of these tax laws selling going on. And basically, that takes me to the January effect, which all it is all those companies that got dumped in December, you know, they all bounce back.
Yeah.
So they're people who all they do is trade this January effect. And I posted a site there on Forbes, the old article that actually went out yesterday, called How I Used the January Effect to Make Money in 23 out of 30 Years. And all this guy does is buy the stocks that get dumped and, you know, plays a reversal.
Yeah.
Because if they're good companies and they're just getting dumped because, you know, I don't know, they had a bad quarter or what have you, you know, chances are they're going to come back. And that's basically what the December, January effects are. Now, just keep in mind that gets compounded by bonuses in December. The idea was that in December people get their bonuses, that'll hit their account. Even if you work at, I don't know, a lawyer or a doctor's office, they might give you, I don't know, an extra week of pay, something like that. And whatever people get, for the most part, is going to go into their brokerage or savings accounts. They're going to invest in something.
Yep.
And now the Wall Street bonuses got moved out to February and March. It's a smaller effect, but there's still plenty there. I don't think it's accentuated as it used to be, where, you know, if Goldman announces they're going to pay out $150 billion in bonuses, you know people are getting that money in December, you know. And that's a lot of money going into the stock market, in mutual funds and what have you. Those guys aren't sitting on cash.
Yeah.
And that's just one firm. But now that they moved that out, or they're spreading it out over 3 to 5 years in stock, that effect is not as big. But you're still going to have the retail side of things. You're still going to have year-end rebalancing for some of the traditional institutions. You're just not going to have the Wall Street bonuses hitting.
I gotcha.
So that's basically it. It's a January effect, December effect. And with that, I think I addressed most of the stuff I wanted to talk about. I just want to give you guys some specific examples of crap that's going to be going on today at the close. So I'm not telling you to buy or sell, but, you know, I'm going to walk you through an example here. So you have S&P indices have announced share changes to the 500, 400, and 600 index. There's basically 3 500 changes, 4 400, and 4 600. Some of these are not significant. Most of these are due to share repurchase plans. There's a couple that are due to acquisitions.
Okay.
So let's take an S&P 500 name here.
Now they're going to have they're going to have this. This is happening today.
This is happening today at the close. Yes.
Okay. Good.
So let's take on the 500. They announced Ecolab, Mosaic, MLS, and Urban Outfitters, URBN.
URBN, Mosaic. What was the other one?
ECL, Ecolab.
ECL. All right.
Yeah, ECL. Now, the way we normally put this in a format to send out to institutions is you tell them what the share change is, what the weight of that stock in the index is, what the new weight is going to be based on the new shares, and more importantly, what the net days volume is. Now, the net days volume is basically how many shares are going to need to trade divided by the average 20-day volume. All right. In this case, for example, Ecolab is showing 2.4 days volume. The other two is it's really a non-event. So an Ecolab, I don't even know what it looks like. But, oh, you got it there.
I'm bringing it up. That's the 5-minute chart.
If you go back to the 23rd, see if there was any price action from the 23rd through today.
All right. Oh, yeah. Well, let's a little obvious price action.
Let me try to bring it out here.
Just a little obvious price action. Absolutely.
All right. So you see that, right? I hadn't looked at it before. So what happens is this. They announce it's changed. Now, if you're an indexer, if you run, I don't know, Vanguard S&P 500 fund, you need to adjust your holdings of Ecolab on the 30th of November. At the close close of the 30th of November. Now, everybody knows that you have to go out and buy it. How you do it is a different story. So what happens is the 23rd it gets announced, that stock's going to pop. Why is it going to pop? Because, number one, it's going to have a greater weight in the index. It's going from 11.5 basis points to 15. Number two, brokers are going to load up on it because they're going to try to sell it to Vanguard at a profit.
Yep.
See what I mean?
Yep.
Vanguard doesn't really care that they're paying higher because their mandate is not to gamble and buy it on the 23rd when it's announced. Yep. Their mandate is to mimic the index and beat it. So what happens? It gets announced. It's 51. I got here a price of
57.
Price 52.68. Right now it's at what?
57. 57 and
That's
change.
$5. So if you're Deutsche Bank, Morgan Stanley, I don't know, any bank, any big broker,
yeah,
and let's say my account is Vanguard, and I have a great relationship with Mike Duke, who runs that index fund. Not that I do. I'm like, let's pretend. So I wish I did, but now Mike says, you know what? I'm going to give you that order. Now I go back to him and I say, you know what, Mike? I'll tell you what. I'll give you a deal at the close. I'll give you, I don't know, what are they offering you? Well, Deutsche is offering me 5 cents better. This guy's offering me 10 cents better. I'm like, well, what do you want? He's like, yeah, give me a quarter better. Done. All right. Now he's going to come out, and I know indexers are going to have to buy 5.3 million shares of this. Right.
Yep.
So if it's 5.3 million shares, let me see this. For every 100 million shares that Vanguard manages, they got to buy 2,000. So I don't know. Figure out how big. I don't even know how big their index fund is, but it's humongous. And multiply it. And you're going to figure out how much they need to buy. And now I have an idea of how much I need to load up on. So I already got, $4 or $5 built in a profit here.
Yeah.
And I'm going to take a loss selling it to him for a quarter less. But what do I care? He's going to pay me a commission on top of that. And that all gets passed down to the little guy.
Wow.
The mutual fund guy, right?
Yeah.
So that's how that game is played. So a lot of people will wait. Let's say somebody in this room. Did I lose you? You're still there?
Yeah. I'm here.
All right. So somebody in this room, somebody tells them, hey, listen, Ecolab's going in, getting a share change. They go out and buy it today. They're going to get smoked.
Yeah.
Because I can almost guarantee you, if you watch the last 5-10 minutes of trading, some broker is holding the bag on this. And they're going to dump it because, they don't need it tomorrow. They just want it today. So today after the close, it's worthless to them. So they're all going to go out and dump at the end. So you're going to see a lot of volume spikes, and you're going to see that price move up and down and up and down and up and down.
Well, we're going to tune into that one.
All right. So that's one on the 500. On the 400, there are 4 of them. There's really not much activity. I mean, it's very little volume, but I'll let you know what they are. They are CPRT, FICO, PNM, Paul Nancy Mary, and TRH, Transatlantic Holdings. These are all adjustments to the share repurchase programs. Some of these, they're very small, but they still need to be adjusted.
Yeah, all right.
And on the 600 there's 4 changes. You got HAFC, Hanley Financial, HOTP, Hot Topic, STMP, Stamps.com. All these are small also, all right?
Yeah.
One is due to the exercise of options, the other one's an equity offering, and the other one's a share repurchase plan.
And you got this information from where?
I call my buddies and, pull favors.
Okay, there's not
I knew I was going to talk, so I told them, to tell me what they have. I can't really send it out because it's got, company letterhead.
Oh, yeah, no. I didn't know if there was a website on that. I know the news comes, I'm sure.
No, this, you can do this. If you subscribe to the S&P Index Alert service, S&P makes announcements 4 times a day, at 10:15, at 12:30, at 2:30, and at, I think it's 5:15. And, so we on the desk have somebody, we used to rotate it, and you check periodically at those times. And, if there's an announcement to be made, it's going to be announced at that time.
Okay.
And a lot of times, I know on prop desks, you're hitting that button like trying to make a tea time. I don't know if anybody's ever had to do that where you call in the number and you got to get in by a certain time. And as soon as that announcement comes out, whatever ticker's on there, they just go out and buy it. And they just go out and buy it just in case it was a buy.
Yeah.
They can be in front of everybody else. It was sort of ridiculous. And but they announce 4 times a day, and all you have to do is download to a spreadsheet the S&P 500 constituents, which are all 500 names, price, shares outstanding, and the weight of each name in the index, which you can figure out by dividing the market cap of each name by the total market cap.
Okay.
So if you add the market capitalization of all 500 stocks, right, and you use that as your denominator, and you divide each market cap by that denominator, you're going to get a weight, and you have that weight up, it should add to 100, right?
Yep.
100%. So then when they make the announcement, they're going to tell you, we're adjusting the shares from, it's always a share adjustment. So they're adjusting the shares from, let's say, an ECL from 19.8 million to 25.7 million. So all you do is you plug in 25.7, it's going to give you a new weight and a new market cap. Multiply that by however many dollars follow the index, and you're going to have an idea of how much money is going to be changing hands on that stock,
Yep, gotcha.
If it's significant or not. But you have to subscribe to the index is how it works.
Yep.
So anyway, on the 600, the last name here, and this one is significant, is NARA, Nara Bancorp. Now, these guys issued 31 million shares to acquire Center Financial. So obviously, even though it dilutes the company, they now have an extra 31 million shares in the index that needs to be accounted for. So their shares are going from, let's see, I don't have that from this one. Let me see if this, I don't have it up. 76.8 to, it's showing me it's 4.2 days volume. Now, I haven't even looked at the chart on this thing, but NARA. No, Nancy Apple, Robert Apple.
Okay. Yeah, it was getting a little
This was also announced on the 23rd. These were all announced on the 23rd.
Gotcha.
All right, so I just pulled this up. All right, so on the announcement, this thing was announced at, what was the price?
You could even see the
$2.30.
Yeah, you see the move on it. It did make that move.
Well, not just that. Notice that it moved and it was gapped up day after day, even when we were going down.
Yeah, that's really the divergence you're seeing. So
right. So it went from 8.30 to 9.30. It went up $1 on an $8 stock. That's significant.
That's pretty
good. So
good.
again, these are all the brokers buying it, and what's going to happen is they're going to sell it out to their clients at the end of the day.
So someone came up with a question before, and they said, well, we're talking about the we'll go back to ECL and saying there's going to be a bag holder at the end of the day and they don't need it and they're going to dump the shares. Would this be a short setup?
Well, the thing is, we don't know if they're going to dump the shares.
Yeah.
It's on a specific basis. So, for example...
and why would they if it's performing?
The name of the game is this, okay? It's you're trying to estimate how many shares need to be bought by all the indexers out there. All right? So everybody who manages an index fund that contains this name needs to go out and adjust their holdings. So you've got to figure out how much that is in volume, right? Then you have to try to estimate, okay, so out of the total pie of people buying it, how many are going to buy it from me? And then, all the banks will go out and buy the stock. Now, what could happen is, let's say, just to use the same banks again, Deutsche, Morgan, and Goldman all talk to the guy at Vanguard. And the guy at Vanguard's playing mind games with them and says, yeah, I'll take care of you, buddy, I'll take care of you. Now, all three of these guys think they're going to get that order, but so they all go out and buy a certain number of shares thinking that they're going to sell it to Vanguard.
Yeah.
The Vanguard's only going to buy it from one guy. They're not going to buy 3 times what they need. So now they come out and, they buy it from Goldman. So Morgan Stanley and Deutsche have all these shares And as pissed off as they might be because they didn't get the order, what are they going to do with it? They got to sell it. They're going to dump it, you know? And that's what's going to happen. Now, there's no way to really estimate that because we don't know what broker holds how many shares. But you can look at the volume.
Yeah.
You can see how much has been bought over the last 3 days. Now, that doesn't mean to say that all that volume is from the big banks. There could be a lot of guys like you and me out there who are trying to buy it, but, you know, we're not going to do huge volume spikes. Yeah. A lot of hedge funds are going to be buying it, too.
Yeah.
And they're doing it for their own pocket. So the only thing you can really do is find out when, you know, when the announcement comes out and buy some stock, hold it up until the last day, and then get rid of it.
Yeah.
And then what some people even do is they get rid of it the day before expiration. So if you look at what's going on today, the stock gapped up, obviously, because the whole market gapped up, went all the way to 950, and now it's trading near the lows of the day, while the overall market is trading, making new highs. You see that?
Yeah.
So a lot of people buy it on the announcement day, and they'll get rid of it on the close the day before.
Yeah.
Because the gyration and the volatility that's going to happen between now and the close is going to be huge. I mean, this thing could close down a buck. Who knows? I mean, I'm just saying, for your viewers, watch this. You know, just watch it.
Watch the volatility. That's what we're going to see is the volatility in the thing. The trade is already basically over. The trade was when they made the announcement to hold it, you know, and get that run up. The trade is over with now. I mean, it would be foolish just to try to guess the direction. But, you know, it just shows you good techniques. Like each one of these, I call them like kind of little styles, methods of trade. You can become an expert at this type. You could become an expert on rebalancing trading or expert on, you know, these different techniques and things that you could decipher from the overall markets and you know, kind of put it all together to help you trade the markets. And when that time approaches, you basically put that put that uniform on and play that game.
Correct.
It's great. You know, this is great information, Vander. I mean, you know, I have questions here. We could hit up on some of those if you don't mind.
Yeah, no problem. Let me just post the last thing I have for you guys up there, and then I'll answer all your questions.
Yeah, sure.
Just one more thing. So, the one more thing I have for you, I got my hands on the MSCI rebalance.
Okay.
It's
what is that? What rebalance is that?
The Morgan Stanley has they created the first world indices. I don't know if everybody's ever heard of BARA Research, BRA.
Yeah, no, MSCI. All right, so all right, go ahead.
Right, Morgan Stanley Capital International Indices. They're most widely followed worldwide indices on the planet. They've been around forever, and basically, if you're a huge institution, you follow this. Gotcha. And you've got money tied into it. There's 4 major indices that are going to be rebalanced today. I posted the link to the site for the MSCI site, but I'll do it again in case anybody wants to take a peek. So within all these indices, 2 of them are going to be U.S.-based, the ones that are being rebalanced today. And they're small cap, micro cap.
Excuse me.
The rest are, you know, world indices. So they contain, you know, Japanese stocks, European stocks, you know, the big ones, Nestle, what do you call this, Airbus, you know, big companies from overseas, Komatsu, what have you. Now, at the same time, all those other countries have their own version of the MSCI indices, but their version contains U.S. stocks in their, you know. So if you're a German money manager and you're looking at the world index, you don't have German stocks in there, but you got U.S. stocks, right?
Yep.
If you combine what the Japanese, the Koreans, the Germans, the Dutch, you know, the Austrians, every other country is looking at, they need to rebalance a good portion of U.S. stocks that we don't see here because it's not part of our index, you know what I mean? Because we're just looking overseas. And that's the information that's really hard to come by. It usually comes from London, but I was able to pull a couple strings, and I got myself a list, and it's, you know, 1,800 and so names. So I'm not going to post all 1,800 names, but to give you an idea, I'm going to take the top 10 and the bottom 10. The top 10 buys and the bottom 10 sells, just simply ranked by the number of days volume. And again, the number of days volume is, you figure out the amount of shares that need to be rebalanced. You divide that by the 20-day average volume, 20-day average volume. So let's say if you got you need to rebalance 1 million shares of XYZ, and XYZ averages 200,000 shares a day, the average day's volume is going to be 5 times, you know? And that's going to be significant because 5 times will move the stock.
Yeah.
So I'm going to put here, the way I have this is in ticker, shares to buy in thousands, and then number of days volume. So I'm going to put these here. Hopefully you guys can, you know, go nuts. Again, I'm not saying buy or sell these. I never really had to deal with rebalancing the MSCI, so I really don't know all that much about it, about the, you know, how it works at the end of the day, other than I'm guessing the same game's being played than with the rest of them. But there you go. Those are the top, you know, they'll post 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 and 10.
Excellent.
All right, so that's that, and that's just, you know, I would just recommend people watch this, and, you know, look at the little charts, and you're going to see the needle moving up and down like if it was an earthquake in the last 5 minutes of the day. Yeah. And the key is to know what they are ahead of time and try to game them. So if you get the top 10 and bottom 10, what I used to, for example, do in quarterly rebalances that were, this is, you know, going back 10 years ago, but it worked before it was all played out, was I would take the top 10 buys, bottom 10 buys, or 15 or 20, and, you know, figure out how much money we're going to throw at it. I mean, back at the time we were throwing $10 million aside, and, you know, you assign a certain dollar amount to each stock, you divide it by the price, you get the number of shares you got to trade, and I would buy them at, you know, 2:30 in the afternoon. So I had I would go long all the buys, and I would short all the ones I need to you know, the bottom set, the top 10 sells or 15. And so I was basically dollar neutral, and I was trying to be risk neutral as well, you know. And then, you know, I would start doing that, legging it in like at 2:30 in the afternoon, take 15, 20 minutes to put on the trade, and I'd sit on it, and at about 10 minutes to the close, I'd start getting out of it. Because in the last hour, the brokers would come in, and, you know, they'd be buying it up in the last hour to sell it back to the clients at the close, right?
Yep.
They don't do that anymore because everybody knows that they're doing that. Now they do it days ahead of time.
Yeah.
You know, but you will still see volume spikes in the last hour, you know, and people are going to be playing it. They're going to try to game it, and, you know, some people are going to get their ass handed to them. That's just how, I mean, seriously, that's just how it goes. So
it is. It is. You play the game, you're playing, you know, you're playing with fire at that time.
Right. So times have changed. It's been more games. That's not to say you can't make money. You just got to be more cautious about it. I mean, there was a time when we used to come in and do this very, very easily and make money, you know, 100% of the time. Just to, you know, buying the top, the ones that you knew were going to go up. And at the time, I remember specifically, we're talking names like Intel, Microsoft, that were the top 10 buys. Now, you go in and you buy Microsoft, you know, you're not going to put a dent in it.
Yep.
Yeah,
absolutely.
But 10 years ago, it moved. And now, you know, I wouldn't even try to do that trade anymore. It just, the juice is out of it. And chances are, I mean, the last time we tried to do it, and, you know, we were kind of like watching it, it actually went the other way.
Yeah.
You know, instead of the buys going up and the sells going down, the buys got dumped and the sells spiked. Why? Because by then, all the brokers already had this in their inventory, and they were just reversing out of the trade.
Yeah, like everything else. Eventually, it's, you know, there's going to be the front runners.
Yeah. So basically, with that said, I'm basically done saying what I have to say.
Wow. And
hopefully, I sound smarter on the phone than I do in the chat.
Hey, Vander, man, you've really impressed a lot of people.
Of stupid crap out there, but whatever.
No, you know what? A true professional. You're outstanding. You know, one of the best guests we've ever had on. I'm getting phone calls in the office actually asking who this person is on the radio, and I tell Brian to tell him it's Stay Tuned or Rockstar, but I don't think they're falling for it.
Yeah, hopefully, nobody's from one of my former compliance officers.
No, don't worry about anything. Excellent, man. I mean, there's so much information that you bring us, and there's so many different ways we could take this thing. I'm just going to throw out some emails that are coming in. Great questions. I have a couple questions. Here's a question coming in from Cousin Vinny.
Okay.
He says, Gas, explain this one. Can you explain this, Vander? An example, stock XYZ traded in a $2 range, closing at the highs. Specialists many times get fills after hours that are $1 lower than XYZ. Then the price sometimes comes back to the close, sometimes not. How is this possible? I don't know. I don't understand really the bottom part of that question. Maybe you did. Specialists.
Well, on the $2 stock, I don't think there's
a $2 range. It says a $2 range. It closed at the highs. It says specialists many times get fills after hours that are dollars lower. I guess he's looking at the time and sales and seeing late prints coming in.
Yeah, and those prints, if you look at time and sales, they'll probably have like little asterisks and question marks and apostrophes, and there's all kinds of different what do you call them? We call them modifiers that you can put on an order, and when you do that, you post them after the close. So the rules state that you have to post to the tape within 90 seconds. So let's just say I had a client come in and he wanted to buy, I don't know, Bank of America, right? And I have a seller that I know, some guy across the hall is selling Bank of America. So I got two phones. I'm talking to him. I'm talking to the client. We're trying to strike a price. We strike a price. Customer's happy. Now you got 90 seconds to put that print on the tape. But if I'm busy doing other stuff, I might not be able to get it. So now I got the print of the tape. You have to run to another room, get the what's called the AUTEX operator, or to put that print on the tape. He's got to type it in manually because it's still not automated.
Yeah.
And if you go over 90 seconds, they're going to come looking for you. And so what you do is you put on the print after the close and you put modifiers on it. Late print, this, that, share repurchase. I used to trade a lot of buybacks at one point for corporations, and when you're doing a share repurchase plan, you're held to all kinds of crazy rules, like you can't buy on an uptick, and the reason they do that is so you don't move the market up.
Yeah.
But you're always going to be support. So I'm always sitting on the bid side, and that stock ain't going down because I got hundreds of millions of dollars of the company that want me to buy that stock. So if a big seller comes along and says, hey, I want to sell a block of this and I want to buy, that transaction could take half an hour, because now it's not a broker to broker. You're talking about a company, and now you got to talk to the treasurer. He's got to get approval. And by the time the transaction is done, 90 seconds came and went. I mean, it could be like 2 hours later.
Yeah.
So now I got to put that print on the tape in time of sales, and I'm going to go down to the New York Stock Exchange, get permission to do it, get the modifiers if it's big enough, and I'm going to post it after the close. And sometimes what that'll do is it'll make the chart look funny. You know what I mean?
Gotcha.
And that's why. But you just got to look for those modifiers. That's the only reason that happens. Other times, the specialist could be sitting on something, and it's not necessarily that he's taking the best price for himself, but he could, because if a market order big enough comes in the last second, he could stop that order, and when you get stopped, you're almost guaranteed a certain price.
Yeah.
That print can come in later. So once you get stopped and the market keeps moving, he could take the other side of that and print it later on, and that could make the tape look funny as well.
Yeah.
But today, especially today, with those names I mentioned, I'd be surprised if there isn't like some crazy gyrations going on with some of those names, especially on the S&P 500 ones. And if you look at the time of sales after 4 o'clock, you're going to see all kinds of prints with modifiers and acronyms afterwards. If you get level 2, that is, you'll be able to see it.
Okay, I got another question here. Hi, DTRS. Appreciate if you can ask your guest about POMO, or the so-called quantitative easing, and how it works. We hear Fed gives money to banks as part of the POMO, and the banks pop up the market. Institutions and banks team up to intervene in the market.
QE, you want me to just basically explain what QE is and how it works?
Yeah, and what basically, what the Fed is doing these days when you hear that POMO is in effect?
Well, I'm really not that familiar with POMO. I got to apologize. I'm not going to try to make it up. I'm not sure about the acronym because, I've been I try to stay away from newspapers lately, and I haven't been in the city and sitting on the desk as well. But I do know quite well how the whole QE works. And what I have posted once in a while in the chat is I am absolutely 100% positive that Mr. Bernanke at one point said that the Fed will support equity markets at all costs.
Yeah.
So by saying that and then reiterating that they have been doing that, the only way for them to support equity markets is to basically, sit there and, I would say, like, create a floor.
Mm-hmm.
But, when there were times when there was no reason for this market to, like, move higher on zero volume. There were times when the market was going down and out of nowhere came a huge buyer. There were times when, especially in the overnight session, because in the overnight session, you can move the markets up very easily on low volume. They intervene. It's easier for them to intervene in the overnight session.
Yeah.
If you look over the last week or two, notice how, I wouldn't say 2 weeks, but let's say a week and a half, right, when this whole down move started, or maybe even 2 weeks. The market closes, you look at the overnight session, and more often than not, it trades higher.
Yeah.
And then we come in, we take it a little bit higher, and then we dump.
Yeah.
And the next day, it's the same thing. So could the Fed be, artificially or, intervening in equity markets to support them? I'm not saying through buying ES necessarily, but doing whatever they can.
Yeah.
Absolutely. And that's what I call manipulation. That I don't call high-frequency trading manipulation. I call that manipulation because I don't think they have any business doing that. The credit market, they haven't been able to stabilize credit markets, so they're moving to stabilize equity markets. What they did today with that announcement, because it's November 30th, the magnitude of that, and that move on the S&P today, which is, it's just ridiculous, 50 points? That's humongous. It's huge. I can't see the market doing that strictly on its own like that.
Yeah.
What are we up, 37.5? With regards to QE, QE really has not much to do with the them helping directly the equity markets. The way QE worked, and I thought sort of it was a necessary evil, but it doesn't do the U.S. taxpayer any good. What they call quantitative easing was simply their ability to not just print more money, but when they went out and forced the banks to take money, because they forced a lot of banks that didn't need it to actually take billions of dollars of taxpayer dollar money so they could remain solvent, which really meant make their balance sheets look better. The way they padded that balance sheet was as follows. If I give you a tax-free loan, and basically I'm giving you a loan at zero interest rates, or next to nothing, and all you have to do is buy treasuries with that money. Now you're going to earn that treasury rate of return with zero risk, because the government's giving you this money and telling you, now take that money and buy my treasuries. So your risk is nothing. In essence, they're giving you treasuries for free. You see what I mean?
Yep.
And who's paying the interest on that treasury? The taxpayer. And where does that interest income go on the bank's balance sheet? It goes to the bottom line. So all they're doing is padding that bottom line of the banks to make them look better and make them look more solvent. And that's all it was. All they did was shift taxpayer dollars into the bank's coffers. And some banks didn't want the money, but they were forced to take it. There was that big meeting in Washington when it was decided they were going to let Lehman collapse. All the big heads of the bankers were there, Jamie Dimon and all the other guys, and they were given X number of dollars to buy treasuries with. So on one hand, it was sort of a smart move because there were less and less buyers of U.S. Treasury securities. They kept coming up with auctions, and there were less buyers showing up to the table. So the fear became, well, if nobody's buying, we got to start raising the yield on these Treasury securities. And in effect, by doing so, you're sort of like devaluing the currency. And it was just not a good deal. It was sort of like a necessary evil, but the U.S. taxpayer got screwed. And that's what happened in QE1, QE2.
Yeah.
I don't know if that's going to happen again. And then the other thing was, after a certain period of time, when the Fed started announcing, they basically gave banks a heads up that it was time for them to, give the money back. And that was a pretty interesting trade with regards to if anybody had held fixed income instruments. I used to own a lot of New Jersey muni bonds, and that was an easy trade. And that was when that dimwit Meredith Whitney saying, all these municipalities are going to collapse. At the same time, the federal government's telling people, hey, we're going to maintain interest rates at zero. You basically got a free ARB. And when they told the banks to give that money back, I looked at my trade and got rid of my munis. But it was very easy. I took a line of money out from my line of credit, which I'm paying next to nothing, and I was getting 7-8% tax free.
Yep.
And that newsletter that I posted a link to at the beginning, they cover a lot of stuff like that, and it's pretty valuable information. Those guys are not for profit, so they're not gaining this either. That's all necessarily I can say about the QE.
Good, nice. I had a couple questions for you, Vander. I was just thinking of my own information things, and I always sometimes, for you've started this back in the '90s, and you've seen a lot of things change, especially when it comes to trading desks, market makers, specialists, high frequency trading, and everything that affects the market. Now you're in, actually another email came in saying, how do you find day trading radio to be, because of all your experience, does day trading radio offer any additional, I don't know, what was the email here? I don't know, I felt weird saying the email, but I'll do it anyway. Well, anyway, one of my questions was, where do you see this? Where do you see trading, trading as what we're doing right now, not in 6 months, but in 6 years? What do you see the history, and what's the future of trading?
Well, I think there's definitely more liquidity in the marketplace now than ever before, and what I mean by that is there's more money being invested in the market, whether it's better pension funds. You have the institutions are just getting bigger and bigger, and all this money that everybody talks about sitting on the sidelines is just, there's just so much cash.
Yeah,
sitting on the sidelines waiting to be invested, and that cash just keeps growing. You're in a almost negative interest rate environment that just creates ample opportunity for people with money to make more money. You're getting almost like a free ARB. You can buy anything. You can buy, for example, Philip Morris. I love Philip Morris. It doesn't move. Stock goes up, doesn't move. Stock goes down. The market goes down, it dumps. It doesn't move, but it's paying you a really nice dividend yield. So let's say if I went and I have a line of credit on my house right now, what is it, prime? I got a prime less 0.7, so I'm paying the effect under 3%. Not to say I'm going to do this, but let's pretend. I went out and I took that line of credit and I buy Philip Morris. Yeah, I got stock risk. Sure, I got company risk. But I'm making 5% free. It's free money, and if you got billions of dollars, if you're a big pension fund or a mutual fund or a hedge fund or an institution, you can go out and buy fixed income. You're not looking for 5% spreads. You're looking for 50 basis points. Now you multiply that out times the amount of money that's in on the sidelines, and it's huge. It's humongous. So I think sooner or later rates will start going up.
Yep.
When that happens, hopefully these equity markets are already stabilized, and even a small influx of that sidelines money coming in, it offers a tremendous benefit to this market. There is almost not a single security out there that someone on day trading radio can't touch. Everything trades.
Yeah.
Everything has some volume. You know what I mean? And as time goes by, it'll become more and more liquid, which means more and more people will own it. It might be more gamed if you want to look at it that way. But that's not a bad thing. It lets you get in and out of securities fairly easily and quickly.
Gotcha.
And I think the more people start looking towards technical analysis, and Johnny, the way you do things, you're looking for that big stochastic spike to lift the stock with it. is, is one method of trading that I think, will never go out of style, and it works. For me personally, I can't, I don't necessarily do that simply because I just like to own, let's say, certain quality companies that have rich premiums in their options and write against it. That's just my thing.
Mm-hmm.
And I collect, especially on the weeklies, there's weekly options. So, and if it doesn't work out, I don't mind. For example, Berkshire Hathaway. Anytime Berkshire goes below 75, I'm buying it.
Yeah.
It's not going to go away. Berkshire's going to come back every single time. When it was at 72, I bought, a couple thousand shares. I sold some 75 calls, which are basically negative now. Yeah, sure, I gave up $2.50 of upside, but what do I care? I made 2.5 points on the stock.
Yeah.
And that's just how I look at it. And then they'll expire. I'll keep my stock, or I'll buy them back, and then I'll do it again, and I'll do it again, and I'll do it again. For day trading, I'd rather try to do the futures. I find that a little bit more, exciting. I don't know, it's more sexy, it's more risky, it's more stupid.
Yeah, no,
so that's why I do it. But, it's so difficult because for me, it's counterintuitive
what you normally
trade,
do.
To just stand in, if, for example, market's going up in a straight line, and everybody's drawing a line in the sand at a certain level saying, okay, we're going to spike off of that, or we're going to head down from there. It's really hard for me to stand there and not feel like I'm going to get run over by a truck.
Yeah.
And sure enough, it pivots on a dime because more and more people are looking at that same line in the sand. So it makes technical analysis it makes it a lot more valid, and it's a self-fulfilling prophecy. I'm just trying to change my perspective and behavior that I've been taught for the last 20 years that, when something's going up, you need to jump on that bandwagon. You can't, go against it.
Yeah, right.
And it's really difficult to do. It's just a matter of retraining your brain.
Yep.
Because it happened at one point. I mean, early when I was at Pru, I started looking at technicals because I had, Ralph Alcampora, a name a lot of you guys probably know. He's like the founder of technical analysis and the, certified chartered technician or chartered market technician certificate. He started that whole thing. He was the top analyst at Prudential.
Yep.
And, I still look at him as like a demigod. Everybody kissed his ass. And he was good. And we had a lot of clients because he was there. Eventually, the firm imploded under the weight of the research department, But, insurance companies still exist, but the broker-dealer died. But anyway, so I used to follow this guy, and in my trading, when I was trying to trade VWAP between those time intervals, I would try to figure out reversals and stuff like that. And a lot of times, let's say I have to buy a stock, and the market's going down, and rather than buy at cheap prices, I'm waiting for, something esoteric to happen. There wasn't a lot of people following technical analysis. Most people dismissed it as mumbo-jumbo. It was all fundamental and quant. And what ended up happening, I would miss the market, and I would get my ass handed to me by the client.
I got you.
So now it probably works. But now you have computers doing that for you. So for the longest time, I was beat over the head to trade a certain way, and I'm trying to retrain myself to do it a different way. So I find your website extremely helpful. There's a lot of guys in there who have this right, that have it down to science. This guy, like, what's his name, Kaneko, he's got, brass balls and taking 60 cars overnight. When it's moving against him, I mean, who does that? But he's so convinced of his convictions, and he takes a very carefree approach to trading, and he does very well. And cousin Vinny does well. There's a lot of guys out there who I stand to learn a lot from, which is why I'm here.
Excellent. I think that was a
now. I'll just mention, probably I won't be here for much longer because, as I mentioned to you in email, over the last few months, I've been talking to certain firms who wanted me back, and I really didn't want to go back and deal with all the politics and what have you of being on those desks unless they were willing to put it in writing. And finally, I got an offer from somebody, and I'm going to take it, probably start next week. And just because I still have, quite a bit of institutional clients, and I still talk to them. I'm friendly. I think I could probably make a go of it. And I know I could always come back to this. I don't think I can do both at the same time.
Yeah,
but
absolutely.
I'll check in periodically. It won't be bad. I'll be here till the end of the week. And if anybody has any questions on anything I spoke about,
Yeah, well, this is great. Vander, you've brought so much quality information to everyone out there. You've made yourself a name. Everyone's in the. Oh, you could see the room yourself, but everyone really appreciates everything. I get another phone call right now. Someone asking about. Do you have a website, Vander? Let's talk about you just for a second as we thank you for being on here. I take it you're from the New York area.
Yeah, I used to live in South Florida, but I moved up here in 2000. So I'm down in Jersey.
Down in Jersey. All right, so you're close by. So we got to get together, maybe.
Yeah, sure. You're up there. By what do you call it? The Army school. What's it called?
Yeah, West Point. I'm a little less. I'm below West Point, but the Tappan Zee Bridge. First exit off the Tappan Zee, and a great interview. People are asking if you haven't, if there's information they want to get in touch with you, is it okay to post that for you? I mean, do you want people to?
Yeah, if you want to put my email address, I don't care, so you can.
I will. I'll throw it out as
I got like 10 of them.
I got a what I would ask you to do if possible. I tried to save most of those links you gave me. I want to put together a little recap post, send out those links to the members, and maybe throw out your just give them a little more information on how to get in touch with you, and you could talk to your fans. And when you go to Wall Street and hit it big, don't forget about us small people here.
Oh yeah. No, I think the days of hitting home runs are over. It's like if I can hit singles and doubles and put my kid through college, then I'll be happy. What I missed the most about that was working there. It was not so much sitting on the desk and doing the trading. It got to the point where I had people doing the trading for me.
Yeah.
But it was a client interaction. That's what I missed. So I'm sitting here in front of screens and doing my own trading and stuff. I used to go out and travel and go out to the Midwest and.
Oh yeah, client interaction. Is that what they call it?
Clients out, play golf with them. You build over years a camaraderie with these people, and the likes of which I'll probably never be able to start from scratch again. Over the years, and I miss that. I miss being able to go out and take them a football game or whatever. I mean, it's not like people might think where you're doing these Las Vegas junkets on private jets. No, again, I missed that. That was before 2000. I came in at the tail end of all that good stuff.
Gotcha.
And but I can take a client out to dinner and spend $100 on a bottle of wine because now you have limits. You can't go out and spend $1,000 on a bottle of wine. Yeah. You can't take them out to a strip bar. You can't do all this stuff you can't do, and for the right reasons.
We're not hanging out.
I never did it anyway, but. It's just nice to get out, so I'm kind of like getting cabin fever, sitting here every day. Sometimes I get up in the middle of the night and I check what the overnight session's doing and stuff like that. And even though I haven't blown up my account, I'm pretty much break even. So I've been trading for months and I'm break even on the ES. I made money on my stocks and options, but I'm still trying to master that.
Yeah.
And it'll turn on you on a dime, and sometimes I tell myself, all right, here's my plan. I got my short stochastic, I got my long stochastic, I'm looking at the advanced decline line, I got the tick, I got this, I got that, my MACD, and when everything lines up, I'm only going to trade when everything lines up,
Yeah.
And once in a while I'll see, like, for example, right now, if that market starts going straight down, it'll be so difficult for me not to jump on it.
Yeah.
It's almost like a train response,
It is. It is because you come from that.
And I feel like I have to jump on it. And as soon as I sell,
that's where you should be buying, though. But anyway, that's because you come from that '90s era of technical analysis and stuff where we were trained to buy breakouts and sell breakdowns. And now I've noticed that when there is a line in the sand, the market will take out that line in the sand just to screw the stops there and then reverse. And that's usually 9 out of 10 times is usually an area to buy. But anyway, we could talk. That could be a whole different conversation. But
yeah, I'll definitely. I try to take the kids to a football game at least once a year at West Point. Usually around. I think I might have missed it, but. If I get up there, I'll definitely give you a ring. Maybe we can get together. I like to see your setup.
Yeah, absolutely. Stay in touch, Vander. I appreciate everything.
Absolutely. I will do that.
Thanks so much for everything.
No problem.
And
I'm going to go have lunch, and then I'll be back here to answer anybody's questions who wants to send me chats here.
And if you happen to have those links, I want to send them to me. If not, I have them bookmarked. I don't want to
yeah, I do. I have a document. I'll drop it in an email right now.
Great, thanks, buddy. All right, man. Have a good one.
Take care.
All right, bye. I got you, Brian. Well, excellent. Once again, I expected a great interview. I think we got a great interview. Someone to share so much information like that, and I recorded it, so we don't have to worry about it. It's recorded. What I'm going to do right now is stop the recording so it's locked in there. This is almost a two-hour interview with someone on the inside. So what we'll do is get that posted. I'll send that out too. I'll send that out on the email list. That way you'll have it in your own mailboxes, and you can listen to it at your own convenience. But now we're back here. Now the market can move, because now the market will be paying attention to, will not be listening to the show anymore. Let's see what's going on here. What I want to do is just stop this recording, save this, make sure I have this, and just give me 5 seconds, and I'll be right back with you.